In this section, what we're going to do is we're going to do financial research on the company. And you'll see here the outline of what we're going to cover. We're going to start with the stock details. Then we're going to talk about guidance, meaning does the company offer guidance, meaning do they tell Wall Street and investors in general what they're going to earn in terms of earnings and revenue in the next quarter or the next year. Then we'll look at historical revenue, historical EPS. We'll analyze historical growth. We'll look at historical gross margin, operating margins, etc. And we'll do the same thing for the competition. And along the way, what I'll do is I'll explain how all of this works from scratch. If you don't have any background in finance and accounting, this will be really helpful. If you do have a lot of background in finance and accounting, you might want to skip through some of the rudimentary lectures where I explain how all of this stuff works. Now, similar to previous sections, I have a ton of prompts for you to copy and paste from this document into ChatGPT or whatever AI product it is you're using. And we'll be able to create a lot of amazing charts together and graphs as well for our research report as we build this comprehensive document together. We'll also look at things like seasonality for the company. And I'm using Apple as an example here. And you can always do a search and replace in this whole document to get rid of the word Apple and replace it with whatever company you're doing research on, of course. Then what we'll do is we'll do a deep forensic dive into the company's accounting practices by looking at all these issues right here, or lack thereof. And then all of this stuff is going to feed into the next section where we're going to build the financial model together. So that's the next section after this one. And after the next section of building the financial model, we'll then value the company as well. And if the company is publicly traded, we'll do technical analysis right at the end as well. Now, what I'm going to cover in this section here, meaning all the financial research, will really help us a lot in the next section when we build our financial model. So in the next section, in the first lecture of the next section, what I'm going to do is I'm going to explain how to use the financial model from scratch, which I've also attached to this lecture here, although we won't be using this until the next section. But if you want to jump right into creating your financial model and understanding how financial modeling works and how to create a revenue forecast, income statement, balance sheet, cash flow statement, and value companies using different methodologies, then you can jump right now to this point here in the course. So for the rest of this section, what I'll do is I'll go through this in a lot of detail, starting in the next lecture with stock details. I'll see you there. The first thing we're going to do is we're going to ask ChatGPT for some of the basic and slightly more advanced stock details on the company. I'll go through each one really quickly. And here's a menu here in terms of what I'm going to discuss in this lecture here in case you want to fast forward. So for this prompt, what we're going to do, this is a long one, is we're going to type here, the task is if the company is publicly traded on the stock market, then get the details only for the capitalized tags below after this double colon right here. And you can delete any of these if you want to, or you can replace them and add additional ones as well if you want. Then if there's any helpful data based on everything we do in this financial analysis and financial research section, we can also insert charts. And I'll show you that along the way. So you can use ChatGPT or any other AI product you want to, as we've tested these on all major platforms. So the first thing I'm going to do is I'm going to copy this prompt here. And what we're going to get is the ticker, the stock price, and a bunch of other information about the company. All right, so let me make sure I select all of this here. Copy. And then I'll go over here to ChatGPT and I will paste this in. So let me submit this and I'll go into high-speed mode until this is returned to us. Great. And what I'm going to do also is in the background, I'm going to paste this into Bard and I'll also paste it directly into Bing Chat. But let's go back to ChatGPT and let's look through this data here. Okay, so it looks like it pulled in the correct closing price as of today. The ticker obviously is there. It doesn't have the shares outstanding. We can easily find that, and maybe Bard will get that for us, or Bing Chat. The average daily trading volume is here, and you always want to make sure that whatever company you're investing in the volume is high so that you can get in and out if need be quickly. Otherwise, what happens is an illiquid stock owns us in a down market versus vice versa. Here's the average daily trading volume. We have here the beta. Now, what the beta measures is how volatile the stock is relative to the index it's on. And so the S&P 500 has got a beta of 1. And since the beta of Apple is 1.31, that means that Apple is 31% more volatile than the S&P 500. What that means is if the S&P goes up 1%, Apple will go up more, meaning 1.31%. If the S&P goes down 1%, Apple will go down 1.31% on average. Then here we have the dividend. In terms of the largest competitor, it only gave us 1, which is Microsoft. I wanted it to give me more than that. Recall that when we pasted this prompt in, we wanted the 10 largest competitors. So we can do one of two things. We can either ask for more detail here in ChatGPT, or we can try a different product. So I'm going to do both. Give me that again, but this time, give me the top 10 competitors. And while we're waiting for this to get updated, I'm going to go to Bard and see what Google came up with. Okay, so Google looks like it came up with similar data. It's actually got shares outstanding. Good. You've got the largest competitor, Microsoft, the stock price of Microsoft, the market capitalization of Microsoft, meaning the number of shares outstanding times the stock price. You've also got Amazon, the second largest competitor, third, fourth, fifth, all the way down here to Samsung and Tencent. And the last one here is Intel, sort of a competitor, but not really. So I really like this data result much better than the one that we currently have within ChatGPT. So what I can do within Google Bard is you can click here to view other drafts, and there's just a different way for it to present the information. It looks similar. Okay. So I'm going to ask Bard, do this again, but don't put words all in caps. That way we can copy and paste. And while that is working, we're going to go back here to see what happened within ChatGPT when I asked for more details. Okay. So it didn't give me the top 10 competitors here. Again, that's why it's good to use multiple AI products. I could ask in different ways and maybe it would give it to me. But just for fun, let's go back to Microsoft Edge to see what we have here. And I'll go into high speed mode. All right, it's not giving me all 10 here. So I'm going to go back and it looks like Bard is the winner right here. Great. Excellent. All right, so now what I can do, thank you. What I can do is I can copy this and we can put this into our document here and move on to the next step. So I'm going to paste special so I don't get all the formatting from Bard there. Here it is here. And what you can always do is do a search and replace on all these 2 asterisks in a row. It does this sometimes. All right. Now what we can do is, just for fun, we can chart this. And what I'm going to do is all this data is in my clipboard already, and I'm going to insert a chart. And so I've got instructions down here on how to insert a chart if you want to. And so you can read through this or just follow with me here. I'm going to ask it to provide me with a chart of the market capitalization and nothing else of, and I'll paste the data in my clipboard. The reason why I want to write it this way is because I don't want ChatGPT to provide me with just a ton of additional text. So I'll write something like this. So the way we do that is we go back here and we create a new chat. And I'm going to type here, provide me with a chart of the market capitalization and nothing else. You can make typos too, it's okay. And I'll paste this in here and we'll get a chart. And I'll go into high speed mode because this can take a little bit of time. And here is the chart. Okay, it did a decent job. You can always type additional prompts like change the colors, make the font larger, etc., and ChatGPT will work for that. Now, the way to copy this into your document, I usually like to take a screen print of it because a lot of times when you right-click and copy, it doesn't seem to work. So if you're using Windows or a Mac, here are the instructions on how to copy and paste or how to insert that image. What I'm going to do is I will delete these instructions right here, and I will go here to Insert Picture from File. Here it is right here. Looks like that. And we are now done with this first part of our financial research. In this lecture, we will talk about revenue guidance and earnings guidance, meaning this section here, revenue guidance, and in this section here, EPS guidance. Now, if you don't know what guidance means, what happens is companies during their quarterly earnings conference calls or in their press releases, what they do is they quite often tell Wall Street investors what to expect for revenue and earnings in the next quarter. And they usually provide it in a range. So they might say something like this. For the next quarter, we're expecting revenue to be between $1 billion and $1.1 billion. And we're expecting earnings to be between 30 cents and 33 cents. And by providing guidance to the street, it helps the Wall Street analysts and institutional investors create their financial models and understand where they should model revenue, in which range, and EPS in which range. Now, from a behavioral finance perspective, different CFOs at different companies that are publicly traded have different styles. And it's important to mention this because some companies will release earnings and revenue at the midpoint of the guided range. So in our hypothetical example here of revenue guidance being between $1 billion and $1.1 billion, they'll release revenue right at the midpoint, meaning $1.05 billion. And earnings, if the guidance is 30 to 33 cents, they'll release it at the midpoint, which is, I guess, about 32 cents or so. Now, some companies will provide guidance and they'll always report above the high end of guidance. And so they're sandbagging. And the same thing with EPS guidance. Some companies will report way above the high end of the range. And it's important to track this so that in your financial model, you can forecast what you think revenue earnings will be for a given quarter. Now, I'll show you where to put this in your financial model, although we're talking about the financial model in the next section. I want to put this on your radar screen now because it's important. So within the financial model, again, we'll talk about this more detail in the next section, including exactly how an income statement works and everything from scratch. But when you enter in your numbers and when professional investors enter their numbers into a model, what they usually do is they add a comment or a note saying what guidance was and what results were. So in our hypothetical scenario here, so right now it's actually this quarter here. So if revenue guidance was between, let's say a CFO guided to 1 billion to 1.1 billion, and if the company reported at the midpoint of that range, you want to track that for every single quarter. And the same thing when you're adding comments to EPS at the bottom here as well. And again, we'll talk about this in more detail next section. But it's important to track all that stuff so that you can figure out what you think revenue and earnings will be in the next quarter. Now, every CFO, let me undo that, Control Z to get rid of that. Every CFO has their own style, and you learn how being an analyst or following them for a while when they release earnings. And Apple, for example, does not provide guidance anymore. I think they stopped back in 2020. But Apple was notorious for being way too conservative to the extent that the revenue and the earnings results they reported were way above the high end of the guided range. So if Apple didn't beat the high end of the guided range, the stock would get crushed. So how can we use ChatGPT for this? Well, I want you to be very, very careful with this because ChatGPT and Bard, especially Bard when it comes to numbers I've discovered, is confidently wrong and it hallucinates. And I'll show you what this means. So remember, Apple does not provide guidance. They stopped providing guidance back in 2020. Watch what happens when I ask Bard to provide me with guidance. Okay. So give me Apple's quarterly guidance for the past 20 quarters. Show revenue and EPS as well. And so what will happen is it will give you what the guidance is. But they don't guide. In fact, they stopped giving guidance back in 2020. So garbage in, garbage out. These are made up numbers here. And so you always have to double and triple check all the data you get from ChatGPT, Bard, Bing Chat, etc. I find the historical stuff is usually correct if it's in an annual report, for example. But when it comes to guidance, I found that Bard of all three AI products is the most misleading. So please be really, really careful with this when you do this analysis. Now, this analysis of getting guidance for Apple is kind of a moot point because Apple stopped providing guidance back in 2020. But what you can do is, if you want to, you can actually go to the prompts we have here, and whatever company name you enter in for your company, when you ask it to get the company's strategy on providing historical revenue and earnings guidance, once you submit this, I want you to please double check the data to see if it's accurate, especially when it comes to forecasts in a financial model. So please be careful with this. If you do get data back, make sure to double check the data always, please. But when you're building a financial model, regardless of whether ChatGPT or AI provides you with the guidance numbers or not, I still want you, please, I say this with love in my heart, to get the actual results by looking through press releases and getting the guided range as well. It's a bit of a manual process, but I promise you it's worth your time as you're building out your financial model. I wish I could provide more value, but I'm trying to keep it real to show you what the limitations are. And always double check the data. As we saw with Google Bard, the data was incorrect. Let's talk about financial analysis when it comes to actual revenue results versus expectations, and also actual EPS results versus expectations. We debated whether or not we should include this in the course. We're going to leave it in because the technology is changing so fast that the results that you get might be more accurate than what we get. Let me explain what this means first before I show you how to use this. And if you don't get the best results from this, then you can skip this part of the financial analysis. Now, please keep in mind that ChatGPT, Google Bard, and all the AI products cannot completely replace the job of the financial analyst, which is a good thing. However, it can make it a lot easier. And so when it comes to gathering financial documents and all of the inputs that we need to create our financial model or do an analysis on a company, what I'm showing you in this course will save you countless hours of time. It would have saved me so many hours for each company that I analyzed when I worked on Wall Street. Now, when you analyze a company's revenue results versus expectations, what you're doing is, this is different from guidance. This is analyzing what the company produced when it comes to revenue and earnings versus Wall Street estimates, meaning the sell side estimates from firms like Goldman Sachs, UBS, etc. So when you run this analysis in ChatGPT, it might work for you, it might not, but I wanted to put this on your radar screen anyway. And if you can't get the answers for what I'm about to show you from ChatGPT or any AI product, then just do a Google search until you find these results, because it's really important to analyze if a company usually beats Wall Street expectations or not. And then in your financial model, which we'll discuss in the next section in this course, you can put this information up here. You can put a note here, right-click and insert a note for revenue and for earnings down here below, just to discuss what results were relative to Wall Street expectations. And keep in mind, this is not guidance. This is just relative to expectations. So I'm going to show you how to do this in ChatGPT, as well as within Bard and Bing Chat. And the data results I get are not perfect yet, but again, I want to leave this in the course because at some point this will work perfectly for you. If not now, skip it. Okay. All right, so what I'm going to do is I'm going to copy this prompt here And it says, get the company's quarterly revenue result versus analyst expectations for all of the most recent 20 quarters. Also provide how much the company beat or missed by in percent terms for all 20 quarters. Then calculate the average beat or miss. Don't just give qualitative information, give quantitative information per the prompt here. Now, I'm going to copy this and I'm going to paste it directly into ChatGPT. When I tested this out, it didn't work for all 20. So what I'll do is I'll type the most recent 8 quarters here to see if it works. It probably won't. We're going to do our best, but by the time you try this, it might work for you. Okay. Now, if all this course was about ratings, we wouldn't include this, but we really care and we want to help you. And if you can't find the details here, then you can always just do a Google search and include that in your financial model. I'll go in high speed right now, and we'll see what the results are in a second. Thank you. Here are the results here. You'll notice it did not go to sec.gov, meaning to the annual report, quarterly reports, or 8Ks, because analyst expectations are not in company documents, but the guidance sometimes is. Apple doesn't guide, though, anymore. Okay, so we got the data here. Let's see if it did a good job. What we're looking for is right here, the percent beat or miss. So you got to double check this data, obviously, but it tells us that for this quarter here, they beat revenue expectations by 1.6%. They missed here and they beat here. Of course, double check everything. Okay. And when it says the revenue was estimated to be between this and this here, that's not guidance. That's usually what Wall Street estimates are. It's confusing. Okay. And again, Apple stopped providing guidance back in 2020. So what we can do is we can ask ChatGPT to put this into a table, and we can ask for more details by saying, do the same analysis on 2021 and 2020. And sometimes when you don't overwhelm the system, instead of asking for 20 quarters, you ask for, say, 5 or 8 for 2 years, it does a better job. If you overwhelm the system as of now, it sometimes will say, oh, I can't do it. Okay, so let's try this now. And let's say, do the same thing, but only show data in a table. Column 1 is the quarter name. Column 2 is revenue expectations. And column 3 is the actual revenue number. Let's see what it comes up with. Yeah, it's not that helpful. It only provides it for 1 quarter. So what I'm going to do is I'm going to ask it to do it again for 2021. And you might have to ask for each year. I don't know yet. We'll see. And I'll show you how to get this data in a cleaner table in a second as well. Do the same thing. Actually, let me first of all change the table structure. So I'm just going to write here, show me this in a markdown table format without using a code box, because when you copy and paste that stuff, it doesn't work that well. All right, so let's do this. Good. And then we'll ask again for, and for some reason only has 1 quarter expectations versus actual revenue. And I doubt that that's correct even. You got to double check all of this data, okay? Because that would be a massive miss. Okay, so do this again for fiscal year 2021. Yeah, it can't find it yet. Okay, let me try now for EPS. Okay, there we go. It worked. Of course, you got to double check this data, like find out if they really missed EPS in Q4 2022. Great. All right. Now do it for the past 20 quarters. Let's see if we can get this. Yeah, it says it can't do it. So you might break it down into more manageable pieces. So what I can do is say, do it again for fiscal year 2021. All right, so we did our best. ChatGPT can't do it right now. So what I'm going to do is we're going to try the exact same thing, but I'm going to use Bard. And I'm not as confident when it comes to using Bard. I found that the data is a little bit misleading. So let me go back here to our document and copy this, and I'll paste it. And we know that when we asked Bard to do this with guidance relative to expectations, it was confidently wrong. Okay. So we know this number here is wrong because there's no way that they report exactly what the market is expecting. Actually, garbage in, garbage out for all of this. I would just ignore this data completely. Okay, Bard, sorry, didn't work. Let's go over now to the last resort, which is Bing Chat. And I'll submit this and we'll see if it can get it correctly. Now, you're going to be taking this course in the future from now. The most obvious thing I've ever said in my life. And it might work for you by the time you try it. When it comes to historical revenue growth, we want to look at revenue growth or lack thereof for at least the past 20 years if we can get all of the historical data. Then we want ChatGPT or whatever AI product you're using to provide us with the percent change on an annual basis and then explain why revenue went up or down in a given year, for example, in 100 words or less. Okay. And the reason we're doing this is because we want to understand the variability in revenue growth so that in the next section, when we create our financial model together, we can understand all the historical trends so that we can accurately discuss the historical trends and forecast future trends. So for example, if revenue was down materially, in Q3 and Q4, for example, for a company that has a calendar year end in 2001, we know it's because of 9/11. If a company's revenue was down a lot in the fall of 2008, it's because of the financial crisis. If a company's revenue was down a lot in the first two quarters actually of 2020, we know it's because of the global pandemic. So we want to understand the year-over-year changes and what caused revenue to go up or down so that we can normalize our estimates and forecast without those black swan or rare events. Similarly, there might be quarters and fiscal years where revenue was up materially because of a new product launch. And the company might not release a new product like that one every single year, so we have to be aware of that. And this will really come in handy for us in terms of looking at seasonal changes too, because the fourth quarter for companies, if they have a calendar year end, usually is the highest revenue quarter. And then Q1, meaning January, February, March, if it has a calendar-based fiscal year, is usually the lowest or a lot lower than Q4. So you got to look at seasonality quarter over quarter and year over year. And this is what ChatGPT is going to help us with. Now, in the next section, when you build out your financial model, and I'll explain all this stuff from scratch, of course, what you can do is you can add comments in many different cells as to why revenue, or any line item really, was up or down materially. And this will help you normalize your estimates in the future for understanding how to forecast the future financial statements. Okay. Let's now go here to Apple's historical revenue growth. So I'm going to copy this, and we're going to go here to ChatGPT. All right, we got two different scenarios here. One of them is sorted by the most recent year first, the other one old to new. Let me go with this one here. It seems like this might have provided more detail. Okay, so we have the historical change each year in revenue. And then below here, it'll explain why we saw spikes and vice versa. So right here, it wrote, we saw revenue growth spike in these years here and colossal growth, I like that word, 2010, because of the successful launch of the iPad. Look at that growth. That is unbelievable. And then continuing sales of iPhone. It gives us more color here as to why we saw spikes. The iPhone 6 was a big hit for them. Then it talks about modest down years, and one of them is due to the pandemic, for example. And what I'm going to do is I'm going to ask ChatGPT to put this into a table. I'm going to stop the generation here for a reason, because I like to see it in a markdown table format without the code. And also one more thing I noticed is I want the reason why there was a change in this column here. So I'm going to write this. Do this again, paste, show me this in markdown table form without using the code box. Also add a third column explaining why revenue changed for each year. I know I made a typo. It's smart enough to know. All right, here are the results here. What we can do is we can copy this and put this directly into our document right here. I don't know if I like that format there. So what I might do is I might go over here to a new chat, and I'll write, put this in a table that I can download in Microsoft Word formats. There's other ways to do this too. You could also say, put it in Excel format, put it in PDF format, etc. And let's click this link here to download the file in Microsoft Word format. Let's open it up. There we go. Copy it all. And let's paste it here. Doesn't look that great. We can always change it up using Microsoft's really helpful table feature here. Put it in that format, etc. And you could play around with this and pretty it up as well. But it's pretty powerful what we've got here. You can always ask for more details from ChatGPT in terms of why was revenue growth this high this year, etc. And it will tell you in a lot of detail. It's powerful. All right, now that I prettied that up, next step, what we can do is we can get a chart of this. So what I'll do is I'll just highlight this data here, copy, or I can just go back to ChatGPT and ask for a follow-up. But I'm going to copy here. I'm going to go to a new chat. I'm going to write this. Provide me with a chart of this data. Let's see what it comes up with. Not bad. Not bad. Okay, the blue line here is revenue in billions. And then this here is a year-over-year change. Unbelievable. This is where the iPad was introduced. I guess around here, these are iPhone releases, etc. Pretty cool. All right, so let me copy this, and I'll put this into our document. You can even ask ChatGPT to pretty this up, make it look nicer, etc. There we go. Let's take a look at the competition's historical revenue growth. So here I wrote, get the company's competition revenue growth details. Don't just give me qualitative information. And if it's going to give me text, no more than 3 sentences per paragraph. And then I added all of these tags down here. You can delete or add more if you want to. So I've got the largest competitor revenue, most recent year, largest competitor revenue before most recent year, depending on when you're creating this. I don't want to put in actual years, and then revenue growth. And I'm doing the same thing for all of the 10 biggest competitors. And right here is other competitor revenue comments. All right, let's take this. Let's go into ChatGPT. Let's see what we get here. So it only gave us 3 competitors. I don't know if I'm too happy with that. So what I'm going to do is we're going to go over to Google Bard and try the same thing. Let me enter the prompt here. Excellent. This is why you don't just use ChatGPT. Oh, just showed me 5. That's good enough. Okay. All right. Now what I'm going to do is I'm going to copy this data here and I'm going to paste it into ChatGPT. And then I'm going to ask ChatGPT to make a chart out of this. So I'll go here, copy, and then we go back to Word. And then we're going to paste special so we don't get all the formatting. And we can do a search and replace for these stars if you want to as well. Now what I'm going to do is I'm going to go to ChatGPT, new chat, make a chart out of this and nothing else. I say nothing else because I don't want to provide a ton of text. Okay, so we have a chart here. It says here revenue for the year 2022, revenue for 21, and revenue growth. Okay, that's great. That'll work. Excellent. All right, so what I'm going to do now is I'm going to copy this and put this into our document. As always, you can ask ChatGPT to pretty this up, change the colors, make the formatting better, etc. Now, when I paste this document in here, I'm going to split it up into 3 different parts. You don't have to watch the rest of this lecture, but I'm going to show you exactly how I'm going to do this. I'm going to go here to Insert, Picture, from File, right here. Good. This might be a bit hard to read. So I'm going to make it bigger, like this. Then I'm going to crop it. Right here, I'll show you. Good. Even bigger. And I'll provide all 3 charts here. So I'll put 2 above this one. So there's 3 charts there. Then I'll go here to crop again. And I'll drag over here. And I'll drag over here to get this first chart. There you go. Rinse, lather, repeat in the next line. Put a space in here. I feel like Bob Ross. Let me give this tree a friend. I'm dating myself there. Anybody recognize that? Okay. Here we go. All right. So we have got now 3 charts nicely spaced out. That's how we say it in Canada. Excellent. And now we are done with looking at the competition's historical revenue growth. If you want, you can ask for more queries. You can say, get the historical annual revenue growth similar to what we did up here for Apple, but do it for every single company year over year and why there is a % change and the explanation if you want. But I think this is good enough for our analysis here. Let's talk about how to get the historical EPS growth for any company. Publicly traded companies obviously have a lot more data than private ones who don't have to disclose. So here we're going to get the EPS growth and the EPS for every single year for the last 20 years. And then what we're going to do is we're going to put this into a table similar to what we did up here for revenue growth. And then we're going to ask for why there were year-over-year changes. Now, the year-over-year change in EPS growth is probably going to be quite different from revenue growth, partially because I remember around this time when I worked in the hedge fund industry, there was a stock options issue with Apple. We'll see if this comes up. It might just be a GAAP and not a non-GAAP issue, but we'll see. And if you don't know what GAAP or non-GAAP is, I explain that in more detail right here in this point of the course. So let's take this and let's copy this. That's not the answer I was looking for, ChatGPT. Sounds like my son. Okay, let's go here to Bard and we'll try it here in Bard. Oops, paste special. Very cool. And let's export this to Sheets. We'll mix it up a bit here. So a sheet is being created for us. Now we can click on this to open the sheet up. And we can format this if we want to as well. And obviously these numbers here, well, actually, is that right? You'd have to double check the data to see if there was really 0% year-over-year growth at this point. As we know with Google's numbers, especially when it comes to estimates, they're not very accurate. So I would double check all of this. I'll go in the high speed mode right now, and I'll pretty this up and put this in our document. Let's take a look now at the data. Here's an outlier here. EPS increased significantly due to COVID pandemic. That's right, more people stayed at home, more people ordered computer equipment. And then here is a bit of a hangover for the company. Next up, and I don't know if this includes all the data because they report earnings on November 2nd. That's going to be on Thursday, which will be Q4. So that might be off. I don't know. You got to double check the data always, especially from Google. Let's see other outliers down here. 93% growth because they introduced the iPad. That was a monster of a year. I remember that. Now, before I make a chart, what I want to do is I want to sort this like we had revenue sorted. As you remember, or at least I had to double check. I couldn't remember. But up here, it started at 2001. So what I'm going to do is I'm going to change the sort here in high speed mode, and I'll create a chart really quickly using ChatGPT. And here's our chart. Looks like on this axis here is EPS, which is the blue line, color-coded nicely. And here we've got the red bars, which is year-over-year percent change. Here is the big uptick from the pandemic. And then also right here, this is when the iPad was introduced. Explosive growth. So what I'll do now is I will quickly copy this and put it into our document. Let's take a look at the competition's EPS growth rate, historically speaking. So what we're going to do is we're going to get the quantitative information, not just qualitative, for the largest competitors' EPS most recent year, the year before, and growth. We'll do this for the top 10 competitors. We'll see if it'll get us all this data. And what I'll do is I will do this in Bard. Copy. Okay, it did it. We got the top 5, and then the other 5, it says here, not publicly disclosed for some reason. So what I'll do is I will take this data here, and we'll copy it, and we'll put it directly into our file. I'm not going to make a chart out of this. You can do so if you want to. And if you want, you can even do the same kind of analysis that we did for Apple when it came to year-over-year change, etc., and the explanation for it. So let me just paste this in here, paste special. And you can pretty it up by just doing a search and replace on these stars if you want. Again, we're not going to be using a chart here, so I'll just gut this part here of this analysis, and we are done. I'm going to explain the income statement from scratch. The most important thing that you can focus on with all financial statements is revenue. And revenue goes at the top of the income statement. Let's spend a little bit of time on revenue, though, because if you understand revenue and you spend most of your time forecasting revenue, then the rest of your financial model is easy. People get really confused by this stuff. It's a lot easier than you think. So revenue and sales is the same thing. And if you forecast revenue into the future correctly, the rest of your financial model is easy because most items become a percent of revenue. And if I told you, this is going to be a silly example. If I told you I have this dice in my hand, and if I throw it, you could probably tell me what the next data point is going to be. Now, an object in motion stays in motion. So pretend this dice here is revenue. Let's just use the revenue brick. Okay. So if revenue is here a couple of years ago, then it grows to here the year after, then the year after right there. What's the next item going to be? Where's it going to be the year after that? Probably up here. Okay. If revenue grows for a couple of years like this historically, and then the next year like this, the next year like this, next year like this, where's the next data point going to be? Probably here. So an object in motion stays in motion. Now, I know I'm oversimplifying this, but it's the easiest way to teach this, and it's so much more fun this way to understand it instead of memorizing. So focus most of your time on revenue. Now, the difference between accounting and finance is accounting is more of a science. You have to be precise, you're backwards looking, everything has to be perfect. Finance is more of an art because you're forecasting the future. You're forecasting the financial statements, and you have to be uncomfortable with uncertainty. But if you forecast revenue correctly, sales, same thing, revenue, sales, same thing, then creating the rest of your financial statements is easy. And I'm going to explain why. So right here we have an income statement. And at the top of the income statement, we know is revenue, which is sales. It's the same thing. And sometimes you'll hear executives say, what is your top line? Well, revenue is the top line of the income statement. So they're referring to revenue. What's your top line growth? What's your revenue growth? And sometimes you'll hear an executive say, what's your bottom line? What do you think your bottom line is? It's the bottom line of the income statement, net income. Net income and profit is the same thing. Okay. Now, if you forecast revenue correctly, then many of these red items here, expense items, are easy to forecast because they're a percent of revenue. So if this item here, which I'll explain in a second, if 2 years ago or 3 years ago, it was 10% of revenue, then last year it was 9% of revenue, or 2 years ago it was 9%, then last year 8%, what's it going to be the next year? Probably 7. Okay. Every item becomes a percent for the most part of revenue. So let's talk about the rest of this. And I don't want to inundate you with all of this, but we've covered net income. You know what that means. We'll talk about these other items in a minute as well. Put these aside. Okay. All right. So revenue is our top line. So our cost of goods sold, and we don't memorize this, we understand it. Our cost of goods sold is how much it costs us to make the stuff we sold. So with an iPhone, for example, I'm going to make these numbers up. But with an iPhone, let's say that I'm Apple and you're the consumer. And I just sold this iPhone to you for $1,000. So $1,000 is my revenue, sales, same thing. And let's say it cost me $300 to make this. I'm Apple. It cost me $300. So the cost of the goods I just sold is $300. So if we take revenue of $1,000 minus $300, then I get what's called gross profit of $700. So the gross profit I made, gross profit means just revenue minus the cost of goods sold, also called COGS. So revenue minus COGS is cost of goods sold. So, revenue minus cost of goods sold is gross profit. This is why I have 2 cameras. I'm going to say that again. Revenue minus the cost of goods sold equals gross profit. And what we can do is we can look at formulas. And financial analysts and Wall Street people like to look at formulas all the time. So sometimes you'll hear them say, what's our gross profit margin? So our gross profit margin is gross profit over revenue. Now, this is crucial. For the rest of your life, I want you to assume that the denominator in every formula is 1. Again, for the rest of your life, I want you to assume that the denominator in any formula, meaning this divided by this, is 1. Why? Because for every $1 in revenue that the company made, the company generated 70 pennies in gross profit. So the gross profit margin is gross profit over revenue. We know gross profit is $700, and we know that revenue is $1,000. That's 70%. Again, for every $1 in revenue the company made, they made 70 pennies. So it's a 70% gross margin. Great. Cool. All right. We are done talking about revenue and the cost of goods sold. Next up, what we're going to do is we are going to move on down to talk about these operating expenses. So these 3 line items are expenses to operate your business, hence the name operating expenses. We've got sales and marketing expenses, like hiring salespeople or marketing online through ads, etc. We got research and development, meaning hire people that do innovation to create cool new products. And then we've got general and administrative. Think of this as the miscellaneous column of expenses. I don't know where to put this stuff, so I'll throw it in general and administrative. Sales and marketing, sometimes they call it S&M. This is R&D, research and development. And this is G&A. And sometimes you'll see companies will combine two line items. So this here will become SG&A. That's what Apple does, I think. All right. A little bit out of order here. That's okay. So now we have operating profit. So operating profit means how much money you have left over after the expenses you see above, these red things. So if we take revenue minus cost of goods sold minus these three expense items, we have operating profit. So let's say that sales or revenue, which is $1,000 minus these red expense line items, gets us to $200. We have $200 in operating profit. So now what we can do is we can calculate our operating profit margin. And $200 divided by $1,000 is 20%. So our operating profit margin is 20%. For every $1 in revenue on the denominator, we're making 20 pennies, 20% operating profit. Capiche? Okay, good. So whenever you hear blah, blah, blah margin, it usually means something over sales. Operating profit margin is operating profit over sales. Sales and revenue is the same thing. Gross profit margin is gross profit over sales. Now, let me reconstruct this in high-speed mode so we can go to the next step. Great. Now, below this line here, we have other items. And sometimes you'll hear CFOs say, what are your below the line numbers? Well, people call this line here operating profit the line. And below this line, you've got interest, taxes, and then net income. And the reason why you leave these things below the line is because these are not items that we use to operate our business. And also, if you focus on operating profit margin, meaning operating profit divided by revenue, or sales, same thing. If you focus on operating profit margin, then it's easier to compare companies in different countries that have different tax rates. So for example, I'm wearing a Swiss watch, and in my pocket, I have an American watch, an Apple Watch. I keep my pocket because I'm on a treadmill. I'm typing all day. I want to count my steps. Too much information, sorry. But if I want to compare an American company to a Swiss company, well, it's better to compare them by looking at operating profit margins, because Switzerland's got a different tax rate than America does, for example. Now, after you calculate what your interest is, right? And interest can be an expense or it can be a source of profit if you have lots of money in the bank. But let's assume it's an expense in this case. You deduct interest, then you calculate your taxes based on all this stuff down to here. So if this is $200 and this is $50, so you're going to pay taxes on $200 minus 50, which equals 150. And if your tax rate is 33%, then you're going to pay 33% of $150 in taxes, which is $50. And then you've got net income, which is your bottom line. So let's just assume for fun that you have $100 in net profit. What do you think the net profit margin is? And what is the math behind that? Well, we know the net profit margin, or the net income margin, same thing, is net income divided by revenue. Well, if this is $1,000 and this is $100, it's 10%. Okay, so that's your net profit margin. So we've got gross profit margin, we've got operating profit margin, and we've got net profit margin as well, net income over revenue. Great. Now, what about depreciation? What the heck is depreciation anyway? Well, it's not really a cash expense. So depreciation means this. I don't know, you buy an iPhone, and for tax reasons, you're allowed to deduct half of this every year and depreciate it. And people do this, companies do this. They spend a lot of money on expensive stuff, so they can claim this on their taxes, so they pay less in tax. So where does depreciation go? Well, depreciation goes right here. It's below here, okay? And so if I tell you that you're supposed to pay 33% tax on 150 bucks, that's 50 bucks in tax. Well, what if I depreciated a phone and in 1 year I depreciate it by 100 bucks? Well, instead of paying taxes on 150 bucks, I'm going to pay taxes on 50 bucks. So what's 33% of 50 bucks? A lot less than the initial taxes of 50 bucks. But it's funny money. It doesn't really exist. It's just an accounting gimmicky thing. And so a lot of times you'll hear investors say, what is your EBITDA? So EBITDA, EBITDA, it stands for earnings before I tricked dumb accountant. Sorry. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So we can put another block here called amortization, which quite often is used when you pay too much for a company and you want to write off part of it as what's called goodwill, sort of. So if this depreciation stuff and amortization stuff confuses you, throw it out the window, don't worry about it, because we're going to adjust for this in our financial model together anyway when we create our cash flow statement. So that's it. That's an income statement in a nutshell. But wait a second. If this isn't real money, think of it like monopoly money, why the hell is it there? I mean, Chris, the income statement's a lie then. I mean, the income statement doesn't tell me how much more cash I'm going to have in my pocket every quarter, because this isn't real money, depreciation. That's why the cash flow statement exists, to tell you what your change in cash is. So it corrects the income statement. Once we get to the cash flow statement to discuss that in more detail, it'll make a lot more sense. So there you have it. Now you understand what an income statement is. And remember, just focus on revenue or sales, same thing. And many of the line items become a percent of revenue. Let me actually show you this in our financial model here. So let me get my keyboard and let me lower this a bit. Alrighty then. So in the financial model that you all have, and it's attached to this lecture here, you'll find there's 7 different tabs. And in this current lecture here, I talked about the income statement and revenue that feeds into the income statement. So as we look through this model, and I'll explain in much more detail how to use this model in this lecture here. In this model here, we see we have revenue at the top. Then we deduct the cost of goods sold, right? We deduct it. Then we've got gross profit right here. Cost of goods sold, gross profit. Then we have sales and marketing right here. Then we have research and development. Then we have G&A, depreciation, which I included. And then we also have right here, operating profit or EBITDA right here. And then other income or interest expense, etc. And then we calculate taxes as well, which I have to spend a lot of time on later. And then we get earnings per share. And there's something called GAAP and non-GAAP. Non-GAAP earnings per share. So GAAP is accounting stuff. It means include depreciation, include all this stuff. Because depreciation it's not a cash expense, but accountants love that stuff. Non-GAAP, also called pro forma, non-GAAP, doesn't include, it's what the finance people love. It doesn't include non-cash stuff. So when I used to work in the hedge fund industry, when companies would report earnings, I would always look at non-GAAP earnings. And companies usually, when they issue their 8K, meaning their earnings press release, quarterly, quite often they provide 2 income statements. One is the non-GAAP one, which I like because I'm a finance person. And the other one is the GAAP one, the accounting people like. I like the non-GAAP one best. Some people call it pro forma as well, because I can update my model really quickly and understand what happened to cash. And it's important to understand what happened to cash, because when you're forecasting net income longer term with a non-GAAP financial statement, there's a high correlation in the long run between net income and cash. And that will come into play when we look at discounted cash flow valuation analysis later on. So now we understand what an income statement is and how it works. And what we're going to be doing is we're going to be looking at historical patterns. So if I enter in some numbers here, let me go here and enter in some numbers. So I'm going to enter here. Let's assume that our company has one revenue line item. So 5, 10, 15, 20. All right. And then let's go here for the next year, next quarter, 25, 30, 35, 40. And this will feed into our income statement here. So right at the top here, we have our income statement. And we see revenue here, sorry. That's growing 100% quarter over quarter, 50%, 33%. And then here, year over year, it's growing 400% right here. It's growing a lot. Right here, it's growing 200% year over year. Anyway, it's growing a lot. But you look at quarter over quarter and year over year changes. And what you also do is you look at each line item as a percent of revenue. So if cost of goods sold was $2, that would mean that gross profit is $3 because 5 minus 2 is 3. And we have 60% gross margins, meaning gross profit divided by revenue is equal to 60%. You can always double click. They're nicely color coded here as well. And so what we will do when we're looking at forecasted financial statements is we'll look at all expense line items as a percent of revenue, and we'll look for patterns in the data. And this will make a lot more sense once we start creating our financial models together in this lecture right here. Please don't memorize this stuff. Enjoy understanding it so you can read financial statements like a good book. Let's talk about the balance sheet. I don't want you to memorize how this works. I want you to enjoy understanding how it works so you'll never forget it. Okay, let's do this. So a balance sheet, it's like a scale. And we know that one side of this has to balance with the other. So in this case, we have James Bond. And he owns a car. And this car is his asset. Sometimes you'll hear people say, this is my asset. That's his car. And he owns 100% of that car. So that's his equity. Equity means I have ownership in. So assets balances with equity. He owns this car, all of it. It's a $100 car. He owns $100 of it. So that is referred to as assets right here. Okay. Now, equity is what Bond is. He's a person that owns this car. There's something called liabilities too. And so assets has to equal liabilities plus equity. These are the same size. So your asset is your car, and James Bond owns 100% of it. So this $100 asset, he has $100 equity in it, and the liabilities is 0. So assets equals liabilities plus equity. 100 equals 0 plus 100. It balances. Now, let's say that this asset is something else. This asset here is a house, and I own 100% of this house. So this house is a $100,000 asset. I have equity of 100% of it, 100 grand. 100 grand equals 100 grand, balances. Assets equals liabilities plus equity. Now let's say that Wells Fargo, which is my mortgage broker, trying here, guys. Let's say that Wells Fargo, which is a bank, lent me $50,000. And I put down $50K on this house, this asset. So my equity is $50,000 in this $100,000 asset. And the other $50,000 I'm liable to pay Wells Fargo to mortgage. So assets still equals liabilities plus equity. Just remember that. Assets equals liabilities plus equity. That's it. So the reason the balance sheet exists is so that we understand what stuff we have and who owns our stuff. So the stuff we have is either owned by a bank or us. Okay, more or less. Great. And think of it this way. This is my asset, my car. I have equity in this car. I'm liable to pay for part of it. So assets equals liabilities plus equity. Make sense? Okay, fine. Great. Let's now take a look at the balance sheet that we have right here. So we talked about the income statement, the balance sheet, just click right here. And we have assets, okay, assets all the way down to here. And we have liabilities. And then we have equity, shareholders' equity, because shareholders own part of the company. So the way it works is assets are broken down into two parts, current assets and long-term assets. So current assets means stuff we can turn into cash in less than a year, like cash, which is cash, short-term investments like treasuries, as well as accounts receivable. Accounts receivable means money owed to us. We're going to receive that. Those are accounts that are receivable to us. And then inventory is also classified as a current asset. Long-term assets are items that usually takes us more than a year to sell if we want to get access to them, like say a building or a factory. Liabilities are also broken up into two different parts. Short-term liabilities, which are current liabilities, meaning stuff we own in less than a year, like credit cards payable or accounts payable or wages payable. And long-term liabilities, like long-term debt. And there's short-term debt as well. And then down here, equities. Equity means ownership. So assets has to equal liabilities plus equity always. Now, inside of equity, what we do is we have what's called retained earnings, which basically means, and this is how the income statement is tied to the balance sheet. Net income goes onto the balance sheet as part of equity retained earnings. And this will make more sense as we go through financial modeling together in a lot more detail. Now, what you can do is a lot of people will talk about formulas that tie the balance sheet together with the income statement. And they'll say return on assets. So return on assets means this over this. Whenever you hear return on, it's net income over something. So return on assets is this, return on equity is this. So return on equity means, remember the rules for when you're dividing. This is number one always. The denominator is 1. This means for every $1 in equity or ownership I have, I'm making this much money. So if my return on equity is 30 cents, that means for every $1 in equity I have, I'm making 30 pennies of net income. And you can also look at return on, right here, return on assets. For every $1 in assets I have, I'm making this much in net income. Now, when I was talking about the income statement, remember I said the income statement's a lie because it includes non-cash items like depreciation? Well, this is one of the reasons why the cash flow statement exists. So the cash flow statement is easy to create. And if I give you the income statement and I give you the balance sheet, you can calculate the entire cash flow statement. And that's what I've done here for you in this financial statement here. So green items means they're linked to another tab. Blue items mean you type in data. And so all this stuff here that's in green, meaning every cell here, is linked to the income statement or it's linked directly to the balance sheet. Now, the cash flow statement will help you understand why cash went up or down on the balance sheet. So we know that cash is from the assets portion of the balance sheet. So the way to understand why cash changed this quarter versus the previous one, or this year versus the previous one, is you look at the cash flow statement. And there's 3 parts to the cash flow statement. There's cash flow from operating activities, cash flow from investing, cash flow from financing. And if you look at all 3 of these together and add all of these numbers up, you'll understand the change in the cash balance from the asset section of your balance sheet. So here's how it works. Whenever you calculate the cash flow statement, you're always going to start with, let me just get net income from the income statement here. You always start with net income at the top, as you can see right here. So we're going to start with the cash flow from operations part. So you start with net income. You get net income from the income statement, of course, and you can double click here to find out where I got this information from here. Then what you do is, we're talking about cash flow from operations. You get net income, and then you add back or deduct stuff that made cash go up or down from your operating activities. So the first thing you do, and this is all calculated for you automatically, is you account for the change in depreciation. So if I took an expense of $50 in depreciation, I add $50 back because I didn't really lose $50. Then what you do is you look at the change, as you can see here, in accounts receivable. And if you mouse over, I explain this to you in more details. So accounts receivable means how much money I'm owed to, or that's owed to me, based on what I've already sold. So if I sold something and I classified it as revenue because I gave it to you, you bought it from me. And if you didn't give me cash yet, well, I probably shouldn't account for that as cash on my income statement. It's accounts receivable. So what I do is I deduct that amount because I haven't received it yet, and vice versa. Then we look at inventory. If inventory went up a lot, that means I built more stuff, which is going to cost me more money. It's cash out of my pocket. So I'll account for that as well, the change in inventory. And then here, accounts payable. If I owe somebody money and I haven't paid them yet, I add that back. And if this seems confusing to you, just mouse over for more definitions here. And you can always double click and play around with the math to see where I got these items from in this cash flow statement here. So that covers cash flow from operations. We got two more to talk about. Cash flow from investing. If I paid a lot of money to buy machines, then it's going to hurt cash flow from investing because it's cash out of my pocket. That's it. Next up, we have cash flow from financing. If I got a short-term loan, then cash would go up that amount. If I got a long-term loan, then cash would go up that amount. If I paid back some debt, cash would go down here. I know it's counterintuitive. You think paying back debt's a good thing. Cash goes down. It's just, it pulls this information directly from the balance sheet. And again, you can double click here to find out where I got all this information from. The same thing with shares. When I issue shares to the public, when I sell shares, two things can happen. I can get money myself if I'm selling the shares directly to the public, or my venture capital investors can get money, or I can create new shares called primary shares. So if I sell shares to the public market and I get that money in return, meaning the company, then that would mean that cash would go up, and that's also part of cash from financing. Add all these three up together, and you've got your cash flow statement. And this will explain the difference in the cash balance from the beginning of the period versus the end of the period. Play around with these numbers. Again, if you're given the income statement and the balance sheet, it should automatically calculate for you the cash flow statement. Now, please keep in mind that every company is a little bit different when it comes to financial statements. So you can't just use my financial model here as a cookie cutter solution for every company, because some companies have more line items. Some companies, what they do is they combine SG&A into one line item, sales, marketing, marketing, and general administrative expenses. Some companies don't. Some companies have a couple extra line items on their balance sheet as well as on their income statement, etc. So take all this with a grain of salt. This is meant for educational purposes, and I hope you enjoy this whole process. And the most fun part about all this is putting in the numbers for the revenue forecasts, which feeds in the income statement. Put in the numbers for the balance sheet. Cash flow statement will automatically be created. You might have to make some minor adjustments. And then based on all of this, we value companies three different ways, which I'll talk about in more detail when we talk about valuation. Thank you. Let's talk about gross margin. For those of you that understand gross margin, fast forward to this point in this lecture, please. So I'll explain what gross margin is. So you take revenue minus the cost of producing that product, and that's gross profit. And then gross profit divided by revenue is gross margin. Let me explain this with a real example. Let's say I'm Apple, and I sell you this for $1,000, this iPhone. You give me $1,000. Well, it cost me $300 to make that iPhone. So my revenue minus the cost of goods sold is going to equal $700. $1,000 minus $300 is $700. So my gross profit, meaning my profit before other stuff, my gross profit is $700. So gross profit margin means gross profit divided by revenue. And so we know that this is 700, this is 1,000. So my gross profit margin is 70%. And for the rest of your life, whenever you see a formula, a division, always think of the denominator as being the number one, especially in finance. Because for every $1 in revenue, I make 70 pennies in gross profit margin. Now let's go to our Word document here and let's calculate the gross margin if we can find it for the last 20 years. And then we're going to ask ChatGPT or whatever AI engine you use in 100 words or less why gross margin changed each year. So let's try this out. Copy. Go over here. Oops, hold on one second. I forgot to turn this on here, custom instructions. Let me turn this on. Good. Great. Let's regenerate now. So a higher number is better. So software companies, pure software companies like Oracle, usually have gross margins approaching 90% because it doesn't really cost them much to, sell a piece of software. It's just delivered electronically. And retail stores, meaning companies like Walmart, for example, and companies that compete with Walmart, they have razor thin gross margins. It can be a couple percent. It can be much, much lower than 90%, I should say. Much lower. Their net profit margins are a couple percent. So here with Apple, we see a trend of gross margins increasing. Probably because they got a little bit more into the services business here. They were more traditional hardware-based company here. And here it explains why gross margins change each year. And so what we'll do, as we always do, is we're going to copy this and we're going to put this into our document here. And what I'll do is I'll actually make a chart out of it as well. Make a chart and nothing else of paste. This is a great response. I love this. It tells you why gross margin changed as well in this chart. That's great. I want to change this axis here to get rid of decimals for the years. On the x-axis, remove decimals. A bit easier to read. Let me ask it to change those numbers to vertical. Change the x-axis labels to vertical. Salvador Dali said, if you strive for perfection, you'll never reach it. That's my alarm to take my kids or my youngest kid out for trick-or-treating. So I will hit stop after this. We get this result here. Okay, that's good. And the date is October 31st. So what I'm going to do is I am going to copy this right here. Good. Then I'll go over here and I'll get rid of the instructions for the chart right here. And then I will go to insert the picture and I'm going to get all the Reese's peanut butter cups that Dylan, my son, gets. It's a tax, All right. There we go. So we'll insert that here and we are done. Thank you. When it comes to the competition's historical gross margins, what we're going to do is we're going to try to get the 10 largest competitors and find out what their gross margins are. And what I've asked here is, as always, please don't just give qualitative information. So let me copy this and we will use ChatGPT to find this. Use search. Let's go. So let me copy this. And next up, we're going to put in a chart of this. So I'm going to type this. Please get me a bar chart of the following and nothing else. There we go. And this is a great way to visualize it. Now, recall that gross margins means gross profit over revenue. And what happens is if companies make products that are software-based or internet-based, meaning they don't really have much inventory, then what happens is their gross profit margins are much, much higher. So it's no surprise here that Microsoft has very high gross profit margins. Yeah. So let me copy this and we'll put this into our report here. And then we are now done with this step. Next up, we have Apple's historical operating margin. And we know that operating margin means you take operating profits divided by revenue. So it's similar to gross margins, except instead of taking gross profits divided by revenue, you take operating profit divided by revenue. And whenever you talk about profit margins, meaning gross profit margins, operating profit margins, or net profit margins, it always means that concept divided by revenue. So if the company has operating profit margins of 30 cents, that means for every $1 in revenue on the denominator, the company makes 30 cents in operating profits. And it's important to analyze this because it doesn't look at below the line items. And below the line items includes items below my hand right here, depreciation, interest, and taxes. And some people call operating profit EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And it's important to look at that if you're comparing companies from different countries, because different countries have different tax rates, etc. So operating profit margin and EBITDA margin is the same thing. So let's copy this prompt right here, and let's see if ChatGPT can get us the past 20 years of data. Let's take a look at the results. And I asked ChatGPT to also explain it for us each year if there was a move. So right here, the operating profit margins were lower because Apple was kind of transitioning a little bit away from a hardware company to a streaming company or a music company, and eventually the iPhone. And so the operating margins started to increase starting around here once the music store was released. And then they released other Apple products here, the Shuffle and the Mini, which had higher margins. And Apple can always charge a high price. And there's two ways to increase margins. One way is to grow revenue, or the other way is to cut expenses, or both. And so in this case, Apple probably grew revenue a lot faster than it grew expenses. And as a result, operating profit increased. Then you saw astonishing growth because the iPhone was introduced here, and then it got even better. You had the iPad launch here, we're up to 28%, and then we're hovering around 30%. And again, what that means is when it comes to 30% operating profit margins, that means for every $1 in revenue, the company has 30 pennies in profit. Always think of the denominator as being the number one. Great. All right, what I'm going to do now is I am going to copy this and paste this directly into our documents. And then I'll ask ChatGPT to make a chart out of this. And here's our chart. It looks decent, except I don't like the fact we have decimals on this axis here. So I will ask ChatGPT to do it again without decimals on x-axis. Now I'll ask really quickly to make these vertical. That looks great. So now, of course, we just copy and paste this directly into our document. Next up, we have the competition's historical operating margin. So what I'm going to do is copy and paste this into ChatGPT. And as always, you know that you can delete these items down here or add more tags down here, all in caps, if you want to. And here are the results. And this would have taken me hours and hours of work when I worked in the hedge fund industry. So I'm going to copy this. We'll paste it directly into our document. And as always, because we have numbers, we're going to ask for a chart. Create a bar chart and nothing else of this. Here's the chart. Looks good to me. Microsoft has the highest operating margins, which makes sense because they're a software company and there's not as many expenses when you're producing something where you don't have big inventory or factories, etc. So let me copy and paste this into our document. Let's talk about valuing companies using PE, meaning price to earnings, and price to revenue. Let's kick it off with price to earnings. Now, ultimately, a company is worth how much profits they make. And if you add it all up, then that's what the company is worth. And we're going to take this to the next level when we talk about discounting future cash flow in this lecture right here. But let's just stick with earnings for now. Earnings and cash flow are the same usually in the long run. So a company is worth however many times investors are willing to pay for their earnings. What does that mean? Well, down here at the bottom of the income statement, you have your earnings. Earnings is also called net profit or net income. And what you do is you take the net profit and you figure out how many shares there are. And then you take net profit divided by the number of shares to get earnings per share. So if a company has, let's say, $1 million in profit, and they have 1 million shares, then $1 million in net profit divided by 1 million shares is 1. So that means they have $1 in earnings per share. So now we know the EPS, earnings per share, it's 1. So now what we have to do is we have to figure out how much are investors going to pay for that $1 in earnings per share. And this is where the P multiple comes into effect. So if a company has a P multiple of 10, that means for every $1 in earnings per share, investors are paying 10 times that $1. And remember, whenever we have a formula, division, always think of the denominator as being the number 1. So a P multiple would be price up here, right? The price of the stock, divided by the earnings. So if a company has a price to earnings ratio of 10, that means price on the top, earnings on the bottom. That means for every $1 in earnings a company has, investors are willing to pay $10 for that $1 in earnings, or 10 times, I should say. So that would be a P multiple of 10. And remember, denominator is always 1, numerator is always a multiple of 1. So if the P again is 10 times, that means for every $1 in earnings, investors are willing to pay $10 or 10 times that $1 in earnings. So why would investors pay more than 10 times or less than 10 times? Well, it all comes down to the earnings growth rate. If a company has earnings that are growing really, really fast, then investors will probably want to pay more than 10 times for that $1 in earnings. And so a great rule of thumb to use is the following. Let's assume that the S&P 500, which is 500 stocks that makes up the US markets, has an average PE historically of 15 times. What does that mean? Well, that means that the average company in the S&P over the long run, for every $1 in earnings or net income or net profit, same thing, for every $1 in earnings the average company in the S&P has, investors are willing to pay 15 times that $1 in earnings, hence a PE multiple of 15 times. Now, the average company in the S&P 500 historically, pardon me, the average company in the S&P 500 historically has about 15% earnings growth. So that means that investors are paying a price to earnings to growth rate or ratio of 1. What does that mean? Well, the PE is 15. The growth is 15%. So 15 over 15 is 1. That's really important to note. And the reason I say that is because if you have companies that are growing faster than 15% for earnings, then they'll probably trade at a premium to 15 times earnings. Makes sense. You pay more for something that's growing faster. So if a company has, let's just say, earnings growth of 20%, then investors will probably want to pay 20 times that $1 in earnings, for example. If a company is growing slower than 15%, say 10% per year in earnings growth, it might trade at 10 times earnings. And that assumes that scenario, the example I gave you there, was a price to earnings divided by growth rate of 1. A PEG, P-E-G, PEG, price earnings to growth rate, a ratio of 1. So how do you know if a company's overvalued then? Well, if the PE to growth rate ratio is way, way above 1, the company might be overvalued. So if we have a company in the S&P 500 that's got a price earnings ratio of 30 and it's only growing at 15%, then the price earnings divided by the growth rate, PE 30 divided by 15 is 2. That's expensive. So the price earnings to growth rate is 2. 1 is kind of a decent benchmark to use. And I'm oversimplifying this, but it's a great way to learn these concepts. And if a company, let's say, has earnings growth of 30% and it's trading at 15 times earnings, that seems pretty cheap to me, because that would imply a price earnings ratio of 15 divided by 30 is 0.5. So the PEG ratio there would be 0.5. And so it's really important to look at earnings growth whenever you're looking to value companies. Now, the way that I value companies is I don't like to look at the price to earnings ratio of this year or next year's estimates. I like to look 5, 10, sometimes 15 years into the future. And I like to value companies I invest in based on what I think their earnings per share is going to be in 5, 10, or 15 years. And this will help you not get worried about near-term volatility in a stock, or if a stock seems expensive based on this year's earnings. And years ago, when I worked in the hedge fund industry, I was long, meaning I owned Amazon and I owned LinkedIn when it was a public company. And both companies were trading at that point in time at a price divided by earnings rate or ratio of 100 times. And people thought I was crazy. They said, Chris, this is a widowmaker, what you're doing. That's awful Wall Street talk. And I would say, no, it's not trading at 100 times earnings. It's trading at 4 times my earnings estimates in 5 years, because I was forecasting massive earnings growth in 5 years from now. And so I always love to value companies based on my earnings estimate many years in the future. As Warren Buffett said, the longer the view, the wiser the intention. Now, what we're going to do, and I'll come to price to revenue in a second, but I want to show you our financial model that you can use to build your financial statements and value companies. So if we go here to our financial model, if we look at the income statement, what you'll be doing is you'll be forecasting earnings per share into the future. And then you can value the company that you're doing research on at your price to earnings estimate in 1, 2, 3, or 5 years from now. I recommend 5 years from now. Then what we're going to do is by the time we get to step 7, and we have a lot of stuff to cover before we get there, what will happen is this will automatically be created for you based on your earnings estimates from your income statement, okay, for all these years. Then what we're going to do is we are going to value the company based on our estimates 1, 2, 3, 4, or 5 years in the future using a couple different methodologies. One is going to be, and if this is confusing, please don't worry, because it's going to be crystal clear by the time we do this together. So what this means is if the company has a price target based on 1 times earnings growth, I call that a bearish price target, because usually the market trades a little bit higher than that, especially for growth stocks. Then I have here a bullish price target would be 2 times the price earnings to growth rate. And just right would be at 1.5 times. And then what we're going to do is we're going to discount that using what's called the weighted average cost of capital. But we're going to get to that much, much later. All you got to remember for now when it comes to price to earnings is investors are willing to pay a multiple of earnings, usually based on the growth rate of the company. So again, if a company has a PE of 10 times, that means for every $1 in earnings per share on the denominator, investors are paying 10 times that $1. If the company is growing faster, they'll pay more than 10 times, and vice versa. And of course, there are a lot of other factors that come into this as well, but we're building on this one Lego brick at a time. Okay, Now you might be thinking to yourself, Chris, okay, I understand. But what if the company is not profitable yet? What do we do in that case? Well, there's a couple things. One thing you can do is you can value the company based on your earnings estimates many years from now, not just this year or next year. But if they're not profitable and you really want to value the company based on this year's numbers or next year's numbers, then what you can do is, instead of looking at the price to earnings ratio, you can look at the price to revenue ratio. And a lot of investors do this for unprofitable tech companies that are private or newly gone public. So the way they value a company based on price to revenue is similar to based on price to earnings, except revenue is in the denominator and not earnings per share. And so it all depends, the price to revenue multiple all depends on the growth rate of the company, and more importantly, what similar companies are trading at on a price to revenue basis. So if a company has a price to revenue multiple of 20 times, that means for every $1 in revenue, investors are paying 20 times that. And it all depends on the market, the sector, the timing, etc. So I'll give you an example. Back in the summer of 2012, I worked at a hedge fund, and what we did was we invested. I headed up software and internet investments. We invested in 3 really good IPOs. One of them was called Splunk, ticker SPLK, which Cisco bought. Another one was called Workday, which is based pretty close to where I live here in the Bay Area. And the ticker there is WDAY. And the other one was called ServiceNow. And Frank Slootman was the CEO. I met with him as well. And those 3 companies, Splunk, ticker was SPLK, Workday, WDAY is a ticker, and ServiceNow, ticker NOW. At that point in time, when those 3 companies were going public in 2012, the market valued those 3 companies that were somewhat similar. They were software, internet companies, cloud-based companies. The market valued them between 15 and 20 times revenue. Now, those companies were not really profitable by the time they went public. They all did incredibly well and grew earnings phenomenally well over a decade. But back then, the way we valued those companies was we valued them based on 15 to 20 times revenue. So the bottom line is this. Value companies if you can. My favorite methodology is price to earnings. And don't just look at what the earnings are, look at the growth rate of earnings as well. That's PE. If the company is not profitable and you really want to value the company based on this year or next year's numbers, you can look at price to revenue. And the price to revenue multiple that you're going to pay should be similar to other companies in the sector that have similar growth rates as well. And later on, what we'll do in this lecture here is we will talk about valuing companies based on cash flow. And in the long run, net income and cash flow usually converge. It's the same thing, usually in the long run. But there's a way to value companies called discounted cash flow, which again, I'll explain later on in this lecture right here. Let's talk about analyzing the historical price to earnings multiple and price to earnings to growth multiple. So what we're going to do is we're going to ask the AI product you're using to get the company's PE ratio, and then get the company's EPS growth, and then calculate the PEG ratio, which is price to earnings ratio divided by growth. And then we explained what that is right here as well, in case ChatGPT didn't know. It probably knows. Please don't just give qualitative information. And then I said no more than 3 sentences per paragraph, and you can read the rest right here. So let me copy and paste this directly into ChatGPT. So let me paste this in and see what the results are. Now, I wasn't happy with the results there, so let me try that again in BART. And always double check the data too. And here we have the results. And so you could chart this if you wanted to. There's not really much to chart. So I'm just going to copy and paste this directly into our document. Of course, you got to double check all the statistics. And according to these statistics, and check the numbers, please, this might not be accurate, but Apple's EPS growth is 8%, and the company is trading at 28 times earnings. 28 divided by this means a price earnings to growth rate of 2.5 times. So that means investors are paying 2.5 times the growth rate, which is pretty high. Again, double check the data. I don't like looking at Wall Street estimates. I like to value companies based on my earnings estimates in 5 to 10 years usually. Let me copy and paste this into our document. Let's take a look at historical valuation on a PE and PEG basis for the competition. So what I'll do is I'll copy this and we'll just look at the 5 biggest competitors on a PE basis, EPS growth ratio basis, and PEG ratio basis as well. And then we told ChatGPT to calculate the PEG ratio, and here's the math to do that. So let's copy this and let's use Bard for this one. And here are the results. So let's copy this, put this in our document, and then we'll create a chart of the competition's PE ratios. And let's go back to ChatGPT, and we'll ask ChatGPT, create a chart and nothing else of. It'll be interesting to see if it puts the PEG ratio and the PE on the same chart. This is pretty good, actually. Up here, we've got the PE ratios of the competition. Amazon's always expensive. Here we've got the EPS growth of the competition, and then the PEG ratios of the competition right here. And you might ask yourself, I don't understand why somebody would pay a ridiculous PEG ratio for any company. Well, it's because this data is based on recent earnings growth data. But a lot of sophisticated growth investors that invest in tech companies that are growing quickly, they don't value companies based on the PE this year or the earnings growth next year. They value companies based on their EPS estimates, their PE estimates, many, many years from now. So let's copy this and let's put this into our document. Let's discuss valuing a company based on a price to revenue ratio, also called price to sales, because sales and revenue is the same thing. Now, investors look at price to revenue usually if a company is not profitable. But let's take a look to see what we come up with here. And we're going to use Google Bard for this one. And here are our results. So what I'll do is I will copy this and we'll paste special in our document. And there's not that much in terms of numbers here, so there's no point in creating a chart. So what I'll do is I will delete this. As always, please double check all the data that you get from any AI product. And here we see some commentary that Apple's price to revenue ratio declined a bit during the pandemic as all stocks got hit hard that year. And it states right here that the price to revenue ratio is above the average company in the S&P 500. Let's take a look at the price to revenue ratios for the biggest competitors. So I wrote here, get the competition's P/R ratios. And then I wrote down here, give the 5 largest competitors price to revenue ratios, as well as additional commentary. Let's see what Bard comes up with. And here are the results. So what we can do is we can copy this directly into our research report, or we can export this to Sheets. Let's do a little bit of both just to mix it up. So I'll export this to Sheets. And while that's being exported, what I'll do is I'll copy this detail here and just paste it into our document. And I'll click here to open Sheets. We'll come back to that in a second. Paste special. Cool. And I'd have to pretty this up, which I'll do in high speed right now. All right, let's go now to Sheets. This happens sometimes. It's a glitch with using bars. So I'll just copy this and paste this directly into our document. And I'll go into high-speed mode to pretty this up as well. And let's put this into a chart. So I'll copy this information here, and we'll go here to ChatGPT, and I'll write this. Make a chart and nothing else of. Here we go. And it was smart enough not to put Yahoo Finance here as well. Nice. All right. I will copy and paste this into our document, and we are done analyzing this. It's really important to analyze companies on a quarterly basis and look closely at seasonality. What I mean by this is this. So let's assume that a company starts their fiscal year on January 1st, meaning the last day of the year is going to be December 31st. And some companies, by the way, will start their fiscal years in different months, depending on what sector they're in. I'll come back to that. So usually what happens is the highest revenue generating quarter is the fourth quarter. And that's October, November, December. And the slowest quarter is usually the first quarter, which is January, February, March. And it depends which country the company is based in. But in Europe, for example, the summer months, meaning parts of Q2 and Q3, especially beginning of Q3, are very, very slow. And you have to look at seasonal data. Otherwise, if you just looked at the fourth quarter for a company's financial statements, you would model explosive growth year over year over year. So you've got to look at the seasonal changes. And what I've done for you is in the financial model that we're going to populate in this lecture here, in the financial model for the income statement, you're going to see that there are big quarter over quarter changes after you enter in the data based on what quarter we're in. And so in the United States, there's this concept called Black Friday. And basically what that means is, the last Friday in November usually is the biggest shopping day of the year. And it's called Black Friday because a lot of retail companies are in the red all year long, meaning they're losing money all year long. And then they break even, they're in the black by Black Friday. It's a monster of a shopping day in the United States. And so the last 3 months of the year are huge, and the first 3 months of the year are not so huge. Now, different companies have different fiscal year ends. Intuitively, we think that all companies will end their fiscal year on December 31st, but they don't. Retail companies, their fiscal year usually ends in January. And the reason is because they want to account for returns after the holiday shopping season. But most companies have their fiscal year starting on January 1st and ending on December 31st. Now, Apple's fiscal year ends in September. And sometimes companies' fiscal years will end at a strange time because the company was founded in a different month. So if a company was founded in May and they start recording financial results in May, then that might be the start of their fiscal year. And in different parts of the world, there are different fiscal year ends. So for example, in Japan, I used to invest a lot in Japanese equities when I worked at Goldman. But in Japan, the fiscal year end is usually in March. So you always have to look at seasonal data. Always, always, always. And it helps you with your financial model as well. If you notice in your financial model that quarter over quarter between Q3 and Q4, you usually see a 10 to 15% increase, then you know what to model every quarter over quarter, within reason, of course. So let's go back to our document and let's ask the AI product we're using to get the company's seasonality data, specifically calculate the quarter over quarter change, percent change, which our model does for you too, in Q2 versus Q1 and all the other quarters versus each other. Then I wrote here, provide 50 or fewer words, less is more, to explain why there is seasonality for the percent changes. And if you want, you can add additional color or details down here, meaning additional tags to look for. So let's copy this and let's paste this into ChatGPT to see what we get for the response. All right, that wasn't helpful. But when we create our financial model, of course, we'll know exactly what the quarter-over-quarter changes were. Let's try Bing. This is good. And the reason why this data is not available is because Apple reports, I think, tomorrow. So what I'll do is I will copy this and we'll put this into our documents. And there's no point in making a chart out of this. By the way, when we create our financial model together, the income statement, which we'll do in this lecture here, what we're going to see is we're going to see these little spark lines that will show us the quarter-over-quarter change. So I'll just hard code a couple numbers here to show you. We'll see the quarter-over-quarter seasonal change here. Let me undo that a couple times. Great. Let's go back to our Edge browser here, and let's copy this data, and we'll paste this into our documents. Ooh, I'll paste special. Let's talk about accounting red flags. We're going to kick it off with a discussion of the auditor name and was there a recent auditor change. When I invest in large publicly traded companies, I always want to see a brand name auditor, for example, KPMG or Deloitte, for example. And what an auditing firm does is after the company's CFO and the finance executives at the company complete all of their financial statements, the auditor will double check them to bless them and say, I approve of this. And it's always scary when a company changes auditors, unless there's a good reason. So what we're going to do is we are going to ask ChatGPT or whatever AI product you're using to get the auditor's name and tell me if there was an auditor change, and if there was, explain why. So let's copy this. I'm not happy with that response. Let's go to Bard. It says no auditor change and they're using Deloitte, but for a second there, it said there was. I caught it there. Let me regenerate to see what's happening here. And remember, you always have to double check everything. Wow. It's astonishing. They showed it right here. How bizarre was that, eh? Okay, so their auditor is Deloitte. Deloitte is an excellent firm. And then it said, yes, they switched from KPMG, also an excellent firm, to Deloitte. You can't get better than these two. All right, let's see why they changed. This is important. Apple did not provide specific reasons for the auditor change in the announcement. However, auditor changes are common. They're not actually. And there are a number of possible reasons why they did this. Okay, all right. I'm going to copy this, but we have to do a little bit more research together on this quickly. So I'm going to go over here and I'm going to paste special. And I'm going to specifically ask ChatGPT. I'll come back to Bard if we need to. And I'm going to write, why did Apple change their auditor from KPMG to Deloitte? And if you make spelling mistakes like I do all the time, it's okay, it knows. What a bizarre response. It talks about a change back in 2009 from KPMG to Ernst & Young, and it said no information is available. All right, tiebreaker. What we're going to do now is we're going to go directly to Microsoft Edge and use Bing. And what I would do is I would go directly to sec.gov to see if there was some sort of a press release on this and why. Let's go directly to the source here now. And as you can see, you can't just completely rely on AI. So when was this article written here? It's dated. So now I have to resort to using Google. I can't just leave us hanging here. And I have to go directly to sec.gov to find out why. I'll do this in high speed to save us time. So I'm in the annual report for Apple on sec.gov, and it says here, Ernst & Young has served as Apple's auditor since 2009. So there might be a mistake, but I still have to do more research. So I'll go into high-speed mode again to see if they issued a press release or some sort of form filing that says that they changed their auditor. Now, every company has an investor relations department that's publicly traded. And some companies will outsource it to smaller firms like the Blue Shirt Group, for example. But Apple has their own investor relations group, of course. And the role of IR is to talk to investors like us and answer our questions. So what I'm going to do is I'm going to look through their IR website really quickly to see if there's any changes to the auditor that's been recently announced. All right, so I'm on the investor relations page here, and it says, who are Apple's independent auditors? It's Ernst & Young. And if I go to the most recent annual report to check who the auditor was, because 10Ks are audited, 10Qs are not so much. Let's go to the 10K. Find auditor. And it's Ernst & Young. So this is a great example of why we can't just rely on AI to give us answers. So Ernst & Young is still their auditor, as it says that right here on their website. So what I'm going to do is right here, I am going to delete this. And this is a great real-time example, unedited, of why we can't just rely on any AI product. So I'm going to copy this and I will paste this here. And the source, I'm going to list as this website here, source. And we are now done looking into who the auditor is. Let's talk about if there is a CFO change. It's always terrifying when a CFO resigns. And I'm going to say this with love in my heart. Please don't take this the wrong way. But if a CFO says that they're resigning for personal reasons, over 90% of the time, that's not true. You always have to find out why. Yeah, always, always, always. And I do feel bad because there are some situations where CFOs do resign for personal reasons. But where there's smoke, there's fire. I always get worried when a CFO resigns, no matter what the circumstances are, within reason. So let's go over here to ChatGPT and let's search for, did the CFO resign? Or was there turnover in the CFO? All right, looks like there was no change. And let me actually do another search of who is Apple's CFO and how long have they been Apple's CFO? And from the response here, we can see that Luca Maestri has been the CFO since 2014, so there's nothing to worry about here. Before that, he worked in various financial positions within Apple as well. So I'll copy and paste this into our research document here. Let's talk about accounts receivable growth versus revenue growth. When we analyze the income statement, if we see that revenue is growing really fast, that's usually a good thing. And you think that's incredible because you think that will filter through and eventually become net income after all expenses are deducted. However, you can't just look at the income statement, because what if a large amount of this revenue was in terms of accounts receivable, meaning I sold you, let's pretend I'm Apple. I sold you an iPhone and you haven't given me the cash yet. So I haven't received the money yet from you. So yeah, revenue is growing, but I haven't received the cash yet. And so the place where you find accounts receivable is in the assets part of the balance sheet. So you want to make sure that you see if accounts receivable is growing faster than revenue. That could be a red flag because you could be giving favorable credit terms to your customers. And that's why the cash flow statement exists. So the cash flow statement will basically correct the income statement. The income statement is kind of a lie because net income doesn't always mean cash because you might have had accounts receivable. So the cash flow statement, specifically the cash flow from operations part of the cash flow statement, will adjust for this. Let me show you this in our financial model. So if we go to Excel here, our financial model, we model revenue growth on the income statement, of course. But if we go to the balance sheet here, this is where we focus on accounts receivable. And we want to make sure that accounts receivable is not growing way faster than revenue. Now, if you have the income statement and you have the balance sheet, then meaning these two items here, the income statement and the balance sheet, then you can figure out what the cash flow statement is automatically. It's built off of these two financial statements, the balance sheet and the income statement. And what the cash flow statement does, we know, is it tells us what the change in cash was from the asset section on the balance sheet from one accounting period to the next. And I'll show you exactly where we can track this in the cash flow statement. So if we click here in the cash flow statement, and all these cells are green, meaning there's nothing to hard code here, the investment banking protocol is only hard code or change numbers that are shaded in blue. So after you create the income statement and balance sheet, the cash flow statement is created for you. And right here is where we track increase or decrease in accounts receivable. And what you can always do in this model I built for you is you can mouse over any of these items here to understand this in more detail. So I wrote here for accounts receivable, if a customer bought a product from us but hasn't paid us yet, then this is called accounts receivable. Since the sale of the product didn't give us the benefit of collecting cash yet, we need to deduct cash from accounts receivable in our cash flow statement here. And again, this will go in the cash flow from operations part of your cash flow statement. Now, let's go to ChatGPT and ask ChatGPT to comment on this. Specifically, is accounts receivable growing faster than revenue? If so, explain why. Okay, that's pretty darn good. We see here that with the most recent data it has for educational purposes, revenue grew a robust amount. Of course, you'd have to double check this. And accounts receivable only grew this much. So that's certainly not a red flag for Apple. So what I'll do is I'll copy this and we'll paste this into our document here. Let's talk about bookings and revenue. If I sell this iPhone to you today, you get it and you give me cash, I get to recognize this as revenue because a service or product has been rendered, meaning given to you. Makes sense. Now, let's say that you buy an iPhone from me, but I haven't delivered it to you yet. So yes, I got the cash from you. I'm Apple. But I can't recognize that revenue by law until I give you this product. So it doesn't go in revenue on the income statement. I can't classify it as revenue yet. So where does it go? I got the cash from you. I haven't given you the product yet. Where does it go? It's not part of revenue. It doesn't go in the income statement. Where does it go? It goes on the balance sheet as part of what's called liabilities. So I'm liable to give you the product. I got the cash, but I haven't given you the product yet. So it goes in liability specifically. It goes in deferred revenue. It's revenue that's deferred until maybe the next quarter. It's deferred until I actually give you the product. And what a lot of analysts do is they will calculate what's called bookings. And bookings means revenue from the most recent quarter plus the change in deferred revenue on this balance sheet versus the previous one. And this can help you understand how healthy the pipeline is for a company. And I'll give you more examples in a second. But sometimes you'll see a company report earnings and revenue, and they beat earnings and they beat revenue, but the stock goes down. And you're like, WTF? Why the face? So what you have to do is look at the balance sheet. Because if they beat revenue and earnings by a lot and the stock goes down, it's because certain sophisticated investors took a look at the liability section of the balance sheet and they saw that deferred revenue went down, meaning the pipeline for future business went down. And for a lot of companies, like whenever you go to a website and you see that, hey, it's only $9.99 per month for this product, and then you look closely, it means you have to pay $9.99 times 12 months for the whole year, so $120. Well, you gave that cash, you gave $120 to that company, but they can't recognize all of it until the quarter is done. So if you pay in advance, yeah, they get the cash. But that revenue they got from you is the deferred revenue. It can't go on their income statement. It's deferred until later. And so again, bookings means revenue from this income statement, the most recent one, plus the change in deferred revenue from the current balance sheet versus the previous one. I'll show you this in our model. So if we go over to our financial model here, on the income statement, of course, we have revenue. But on the balance sheet, you have something called deferred revenue. And you would include deferred revenue here as a liability. And you can add that line item if you want to as well. Deferred revenue. And you can't recognize that. It goes into another bucket, right? It's a liability because you haven't given that product to the customer yet. It's deferred revenue. So that would eventually, that revenue that's deferred will move over to your income statement once you deliver the product. So again, deferred revenue would go as a current liability usually, if you're going to give it to the customer within 12 months. If you're going to give it to the customer more than a year from now, meaning the next fiscal year, you put that here as a longer-term liability. So just remember that. Deferred revenue. And you have to look at the change sequentially in deferred revenue. So bookings equals revenue plus the change in deferred revenue. And we can pull up any financial statement and take a look. I'll show you. So let's go together to sec.gov. And let's take a look at a software company called Oracle, who has offices close to where I live. Their headquarters used to be here in Redwood City. I think they moved to Texas for tax reasons. All right, so let me search here. Let me do that again. And we'll go to their earnings reports. So the 8K means an important press release like earnings. Results. Let's go here. And I will go to the press release. Okay. So this here was one of the most recent quarters that Oracle where they released their numbers. Okay, and they're not a calendar year end company; they're a fiscal year end company. I think they ended in May, I think. So let me go down here to the financial statements. This here is the income statement. Here's revenue, but there's certain revenue that they can't recognize yet because they've been paid for the product, but they haven't given the software, the database software they make or app software they make, etc., to the customer. So we're going to go down here to the balance sheet. All right, down we go. Let's go to liabilities. Here we go, deferred revenue. Right here. So right here, they have deferred revenue. And let's see what the change was sequentially from the May quarter to the August quarter. So that is going to be up. So it's up It's up over, looks like over $2 billion. Deferred revenue changes in millions. That's a healthy increase. So what investors would look at for this quarter is bookings, which is revenue plus the change in deferred revenue. So they would take this number minus this number for the change in deferred revenue, and then they'd add that to revenue, which is right up here, revenue. And that is bookings. Bookings is revenue plus the change in deferred revenue. Very important to analyze. And now you know why sometimes stocks will go down, even though a company might report really good revenue, really good earnings, because deferred revenue, which is a liability on the balance sheet, goes down. So let's now ask ChatGPT for more color on that. So let me copy this. And if it doesn't provide us the details, then of course we can do our own calculation like we just did. And we can't just rely on ChatGPT or any AI product for analysis. We can't get a good answer there. So next up, we'll try Bard. And we know we got to double check all this stuff always. It's deadly otherwise. Wasn't that strange? Did you see that? It gave us the answer and then it deleted it. Doesn't give me much confidence in using Bard. So here, it just disappeared again. So it says, yes, revenue is growing faster than bookings. Why? Apple is recognizing revenue from multi-year contracts sooner than booking the revenue. For example, if Apple sells a customer a 2-year subscription to Apple Music, it will book the entire 2-year contract value in the quarter of the sale. However, it will only recognize revenue from the subscription over a 2-year period. That's not really telling me much. That's just explaining how deferred revenue is supposed to work. All right, so here's what we have to do then. We have to go to the press release directly. We can either go to Apple's website and look at the earnings press release, which we'll do in a second together, or we can go to sec.gov, where the same press release is filed by law. Let's go to Apple's website. Let's mix it up a bit. So I'll type here Apple IR website. And they're going to be reporting tomorrow. Let's go to their most recent financial data, though. Quarterly earnings reports, financial statements. Usually it's part of the press release. Let's see if they report it here even. They do. You can't just rely on these AI products. All right, so we can calculate deferred revenue here. So deferred revenue looks like it went up. I want to look sequentially, though. Give me 1 second. So we're going to have to look at 2 different financial statements here. And of course, once the annual report is released, or the 10Q, the quarterly report, you can get much more details, including doing searches for the word deferred revenue in the financial document itself. And you can read the footnotes, meaning additional commentary they might have. But we're going to calculate it. We're going to look at it together at least here. Okay, so we have 8.2 billion in deferred revenue. And it looks like it's just short-term deferred revenue. That's a liability. So I'll remember that number, 8.2. And revenue for the quarter was 82. So 82 billion for revenue, big company. Deferred revenue was 8.2. Right here, 8.2. Now what we have to do is we have to look at the previous financial statement to see if deferred revenue went up sequentially, which is what we're looking for. So here are the financial statements for the previous quarter. And if we go down here, we see deferred revenue was slightly up, 8.1 rounded down, and deferred revenue for the most recent quarter was 8.2. So it slightly went up. But ChatGPT told us kind of indirectly that Apple doesn't really depend as much on deferred revenue. but there still is a component. It matters more for really, really big software companies like Oracle, but we do have to track it. So that's revenue plus a change in deferred revenue. So what I'll do, just to be consistently bad, is I'll copy this and paste this right here. But hopefully this you learned something from this humbly, and you know that you always have to go directly to the source to do your own analysis. Otherwise, AI would replace all of our jobs, which is not going to happen. If all you did was focus entirely on the income statement, you're missing out on a really, really important part of the financial statement picture, which is inventory. Now, for companies that produce a physical product and sell it, inventory is not going to be reflected on the income statement. And if a company builds too much stuff, meaning they have too much product in inventory, they can literally have a cash crunch and go bankrupt. So you have to look at the balance sheet and you have to analyze inventory. Now, what you want to see, so inventory is an asset and it goes in current assets because it's usually a product that you're making that you can sell in less than a year. Current means less than a year. So you want to go to the assets part of the balance sheet to look at the change in inventory and the inventory dollar amount. And you want to make sure to also analyze the cost of goods sold. When a company sells a product, it comes out of inventory, meaning out of this, and it gets reflected in cost of goods sold. So you want to make sure that you analyze, as I wrote there, is inventory growing faster than cost of goods sold is growing? And that can be deadly if it is, to a massive extent that is. So let's go over here and let's ask ChatGPT to calculate this for us and look and analyze this for us. And if it can't find it, of course, we're going to go right to the source, meaning the income statement and the balance sheet. So I wrote here, is inventory growing faster than COGS, cost of goods sold? If so, explain why. So what I'll do is I'll copy this and we'll paste this into ChatGPT. This is grabbing it right from the source, the two press releases we looked at in the previous lecture. That's a good thing. So here it tells us that in this instance, inventory is in fact growing faster than cost of goods sold. Yeesh. Why is that? It said this could be due to a variety of factors such as Apple preparing for increased demand or new product launches. However, higher growth in inventory relative to COGS could also indicate inefficiencies in inventory management or softer than expected demand. Basically, that said, it's either a serious issue or a not serious issue. Well, in this case, we know that the most recent iPhone was released recently, which is probably why there was a buildup in inventory for Apple ahead of that product launch. So what you want to do is you want to look at inventory changes every single quarter relative to cost of goods sold. And so what we can do, and I'll just copy and paste this here. And what you can do if you want is you can go to Apple's investor relations website and take a look at how inventory has changed and cost of goods sold has changed as well. Cost of goods sold, of course, is from the income statement and inventory is from the balance sheet, assets, current assets. And you can also look at the 10Q, which is the quarterly report, or the 10K, which comes out annually, and look for any color or detail on why there was a change on inventory, etc. It could be if inventory ramps up quite a bit, it could be because there's a massive new product release. Now, one more thing I want to talk about before moving on is something called the working capital ratio and the quick ratio. So working capital is capital we can work with, and working capital is basically current assets relative to current liabilities. So if we go to our balance sheet, working capital ratio would be current assets divided by current liabilities. And that's a great thing to analyze because you want that number to be greater than 1. You want your current assets to be greater than your current liabilities, meaning cash and other short-term investments, marketable securities, etc. You want that to be higher than the amount of money that you're liable to pay. However, that ratio is deadly to look at itself because inventory is included in current assets. So what you can do is you can calculate what's called the quick ratio, which is current assets in brackets, current assets minus inventory divided by current liabilities. Because if the bulk of your current assets is inventory and not cash, it means you could go bankrupt if you don't generate enough cash in a given quarter. And what you can always do from a financial education perspective is you can ask ChatGPT to explain this. And I always do it this way. Explain working capital ratio, and then explain quick ratio in no more than 50 words for each explanation, and then provide an example of each in less than 10 words per example. Yeah, so the working capital ratio is current assets over current liabilities. So in this case, if current assets are 200K and current liabilities are 100K, it's a healthy ratio of 2. You want it to be higher. The quick ratio, also called the acid test ratio, evaluates the exact same thing, but what it does is it gets rid of inventory. That's not right. It's supposed to get rid of inventory. You've got to double check this. What is the quick ratio? I'm telling you, you can't just rely on AI. Yeah, it's current assets minus inventory. Yeah, it's current assets minus inventory. And of course, you want this number to be high as well. You cannot just rely on AI. You always have to double check the data and double check all the qualitative answers you get as well, because quite often, ChatGPT is confidently wrong. It hallucinates. And I say confidently wrong because it gives you the answers with perfect parallel construction quickly. Yeah. So you can't just rely on this. So always double check everything that you look at whenever you're using any AI product. And I say that with love in my heart as always. It's crucial to understand if a company has restated earnings, and if so, why. Really, really important. I remember in the early 2000s, I'm dating myself here, a lot of companies restated earnings because of the way they classified stock options. And if a company restates earnings, it basically lowers investor confidence in the ability of the CFO and the management team to actually report results to the street. And where there's smoke, there's fire. And sometimes it's more for benign reasons. Maybe they made a very small clerical mistake, which is okay if it's not done too many times, because one data point doesn't make a trend. So let's copy this. Over the past few years, did Apple restate earnings? So I'm going to copy this. Let's take a look at the results here. They have not restated in the past couple of years. However, 2018, they reclassified and didn't restate earnings. That's okay. A lot of companies will reclassify. Like years ago, Oracle used to provide a couple of revenue line items, applications and database, and eventually they kind of merged the two. I like more disclosure, but it looks like this is not a material concern with respect to Apple, and it searched the right places. Apple's investor relations went right to the source. So I'll copy this and paste this into our document here. We always want companies to disclose as much information as possible. We love to look at information on a granular basis. If a company usually just provides one revenue line item, and then they switch to providing 3 or 4 revenue line items that make up revenue, that's usually a good thing because it makes our job as financial analysts easier. We can analyze each of the 4, for example, individual revenue line items that feed into total revenue. However, if a company changes the way they disclose revenue so that they go from showing 4 different revenue line items that make up total revenue, and they get rid of that and just give you total revenue. That's usually a negative thing. It might be a negative thing because they're hiding the fact that one of those revenue line items is not really growing. Little side note, you always have to look at organic versus non-organic revenue growth. So organic growth means products that were built, created, R&D was done internally, and then they sell that. Non-organic growth is if they buy a company and you see a spike in revenue temporarily, it's because they bought another company and they're selling those products. And investors get excited because revenue goes up a lot. But the next year, revenue probably doesn't rise as much. And then investors freak out. In fact, big companies like Microsoft, Oracle, and others, what they do is they do very large acquisitions. And strategically, it makes sense. I get it. However, it's a double-edged sword because they have to do a massive acquisition every year. Otherwise, investors see that revenue growth slows down materially. Classic example of this is 2 companies, Microsoft and Oracle. With Microsoft, they have to do a big $8 to $10 billion acquisition every year. Most recently, it was a very big acquisition, Activision. Before that was GitHub, and they bought others as well. The same thing with Oracle. Oracle started out acquiring software companies, big deals back in 2003 when it announced the hostile acquisition of PeopleSoft, ticker PSFT. And then eventually they bought Siebel, and that deal was announced September 8, 2005. I remember that very well. Then they announced they bought Hyperion, then they bought Sun Microsystems, then they bought NetSuite, etc. Rinse, lather, repeat. You have to analyze the year-over-year change in revenue growth that is acquired. And if you invest in a company that does a massive acquisition every year, then you'll see revenue growth every year. But it's a double-edged sword because if they don't do a massive acquisition next year, revenue might not grow much the next year. So always take a look at that. So let's take a look here at changes in accounting disclosure, which is different than accounting restatements. So let's go here and do a search for Apple in disclosure. Apple's pretty good with disclosure. Looks like there hasn't really been any change in disclosure. Of course, I would double check this by going directly to the source. And the way you can do that is you can go to, and I'll show you here. So you can go to, and you can skip the rest of this lecture if you want to. What I'll do though is I'll paste this here. But what you can do is you can go to Investor Relations for Apple. And then you can look at the financial statements over the years. So let's go down here to financial data. You can look at the financial data over the years. So if I go here just for fun to the financial statements for Q1 2019, we'll take a look at revenue in the income statement here and see how many line items they have. They have products and services. Let's see if they've changed that. Products and services, 2 revenue line items, financial statements. Same thing, products and services. Quite often companies, if they provide more disclosure, that's a good thing. If they provide less disclosure, that's a bad thing. In this lecture, we'll look at the change in organic revenue growth, if disclosed. So if a company buys another company, that's not real growth. It's not organic. It's not healthy. Like you eat organic food, that's healthy. So it's non-organic growth. And if you see too much non-organic growth, then that's kind of a red flag because it indicates that the company is not confident in its own R&D internal efforts and they can't innovate. So what they do is they work with investment bankers and they buy versus build. And it's a slippery slope because if you do that, if you buy a big company, investors get excited, and then the year-over-year comparisons get difficult and investors get upset unless you buy another company. So I'll give you a real-life case study. So I think it was in 2014, LinkedIn, the ticker of LinkedIn used to be LNKD. LinkedIn bought Lynda, which is an online education company, for over $1 billion. That was a big deal for them. And investors loved the deal because all of a sudden, LinkedIn's revenue growth went up a lot. And then a year or two later, by I think it was 2016 or so, what happened was LinkedIn missed revenue estimates badly. And they missed because investors got so excited about the Lynda acquisition that investors thought that you'd see a big increase every year in revenue. But it didn't happen. And LinkedIn didn't have enough money to do another big acquisition to make it look like revenue was still growing a lot. So they missed the quarter big time. And then what happened, what usually happens, is when a company misses earnings, investment bankers will call bigger companies and say, hey, that company is down a lot. We think you should buy them. And here are our fees. We think you should buy them. And that's exactly what happened. Microsoft bought LinkedIn because LinkedIn went down a lot. And it made sense too for Microsoft because they can make Outlook maybe relevant longer term. And more recently, what happened was with Activision, and you could do a search on this yourself, it's all publicly disclosed, but there were certain awful issues that occurred within the company. And as a result, the stock got crushed, Activision, ticker ATBI. And then the investment bankers called Microsoft, said, hey, maybe buying Activision might make sense. And so they bought it. And usually when one company buys another one, it's usually a 30% premium. So you always want to take a close look at organic revenue growth. Now, Apple has superb organic revenue growth. They haven't done too many sizable acquisitions as of the recording of this lecture. They bought Beats for a couple $1 billion, which is nothing because their market cap is in the trillions. Let's take a look here. And if you find that the company has done big acquisitions, you want to mention that in your financial statements. So what I used to do when I worked at hedge funds was whenever a company made a big acquisition, I would put it right above the quarter where they made the acquisition. And that would make it easier for me to understand when I was modeling a year later's quarter right here. It allowed me to not get carried away and expect toward growth every single year. You always have to look at organic versus non-organic growth. Let's take a look to see here if ChatGPT can give us any information at all on this. Probably not much, because Apple doesn't do that many material acquisitions. But the acquisition they did at Beats was genius. It basically got them into the audio market. And it's astonishing because Apple gets more revenue every year in terms of AirPod revenue than all of revenue for Adobe. So yes, that deal made a heck of a lot of sense. I'm going to click stop. I'm not happy with the results of this query, even though it went to the right sources. Maybe it went to the source and couldn't find anything. But up here, I see a couple of mistakes. And then here, this is basically telling you organic growth may or may not impact revenue. I'm not happy with this at all. And I know for a fact that Apple doesn't really have that much non-organic growth. So what I'm going to do is over in our document, I'm just going to type here, not available. You can, of course, do more research by searching different AI products in general. But from what we've learned so far in this analysis is that, yes, ChatGPT and other AI products can be very helpful, but we always have to double check the data. Let's talk about GAAP versus non-GAAP accounting. GAAP stands for Generally Accepted Accounting Principles. So not all companies, but some companies will report two sets of financial statements. One is called GAAP and the other is called non-GAAP. GAAP is what accountants love to look at because it includes every accounting entry on an income statement, for example, including non-cash items like depreciation that you see right here. So accountants love looking at GAAP. Finance people don't like looking at GAAP as much. They like looking at financial statements that don't have non-cash stuff in them, like depreciation. This is non-GAAP, also called pro forma. And there's other changes too, like amortization, which is not included here. So why is this important? It's important because we need to understand the difference between GAAP and non-GAAP to understand what our cash flow statement is going to be. So the cash flow statement, what it does is it accounts for all cash and non-cash items to help us understand what the change in cash was quarter over quarter on the balance sheet. So we need to understand if the company has made big changes in terms of how it reports GAAP versus non-GAAP accounting. And let me show you an example of a company that does this, that provides two sets of financial statements. So companies that give you GAAP and non-GAAP financial statements, they usually put them both in the same earnings report. And then quite often there's a table that reconciles or tells you the difference between GAAP and non-GAAP. So let's go over here. Let me get a little bit more room here. So let's go over here to sec.gov, and then we'll take a look at Oracle, big software company. ORCL. Come on, drop down. Here we go, good. And Oracle, the first contract they had was a top secret, now disclosed to the public, declassified, database, a project for the CIA called Project Oracle. Let me hit refresh and try this again. Sometimes this website doesn't work that well. That's why they named the company Oracle. Oh my God, I talk a lot. All right, so I'll do a search here. I'll search for Oracle proper. ORCL, here it is, good. Great. So let's look at their most recent earnings report right here. I had it open before. And we'll go down here, take a look at the press releases. Okay, here we go. So they tell you right here, their GAAP earnings were this, their non-GAAP earnings were this. And so remember before I said that non-GAAP does not include non-cash stuff. So if I take out this expense, which is included in GAAP here, this is when I need 3 arms, then earnings are going to be higher, usually. And so you see in this case here, GAAP earnings, which includes depreciation, this is where the third arm would come in handy, was 86 cents. Non-GAAP, which doesn't include depreciation, was $1.19. Let's drill through this really quickly. And you can see right here, they're actually providing details on NetSuite sales. That's important because they bought NetSuite a couple of years ago. So they're basically helping Wall Street understand what their non-organic growth rate is. But let's go down and look at GAAP versus non-GAAP financial statements. All right, give me a second to digest this. This here is their income statement. Sometimes an income statement is called consolidated statement of operations. That's why you got to understand this stuff, not memorize this stuff. And let's go down here. Here we go. So right here, they give you financial statements, and then they provide you with a reconciliation of GAAP versus non-GAAP, meaning help me understand why non-GAAP earnings was $1.19, but GAAP earnings was 86 cents. There's a table for that. So let's go down here. Here we see the 86 cents for GAAP, and here we see $1.19 for non-GAAP. So why is that? What is the big difference? Well, the adjustment comes in terms of stock compensation right here, because it's not really a cash expense. When you create options and give them to employees, it doesn't cost you money, just give it to them. Investors care because that can cause some dilution. But you want to incentivize your workforce with options so there's golden handcuffs so they stay for a long time. What else do we have? Amortization. So that's $763 million here. And this is another reason why a lot of analysts, when they look at financial statements, they look at operating profit, which is called EBITDA, earnings before interest, taxes, depreciation, amortization. I should have had depreciation down here. Yeah, but I think you get the idea. So here we see that acquisition, that's a relatively small amount. Restructuring, probably want to look into what that means. Maybe they let people go and took a charge for that, which was non-cash. And so that will explain the difference between GAAP and non-GAAP. And a little side note, but whenever companies provide you with more details down below, if you're not sure where to put it in your financial statement, put it below the income statement because you might be able to use that information later on when you're analyzing the company. So you go here to the income statement and you'll just paste that data down here to track it. So if a company provides you with geographic exposure, meaning certain regions of the world, what they made in each quarter, you always want to document that just in case part of the world sees a material economic slowdown or vice versa. By the same token, if a company provides you with vertical exposure, meaning sales to financial services, healthcare sector, government, education, telecommunications, etc., you want to disclose that as well here. And the reason you do is because the company might have had a huge quarter with one vertical, like big sales into the telco sector. And you want to be able to track that so that you can look at the year-over-year comparisons. Kind of like you want to track, if you can, what non-organic growth is by accounting for NetSuite's revenue right here, just like Oracle mentioned up here. And so quite often, companies will actually provide you with two full sets of financial statements, the full non-GAAP and the full GAAP financial statement, so that you can track it instead of having to adjust it manually within your financial model. And again, the reason the cash flow statement exists is to correct the income statement by accounting for just cash stuff. And the cash flow statement, again, will help you understand the difference in the cash balance from the balance sheet from one quarter to the next. But if we scroll down here, see if there's any more details we want to put into our financial model. They even provide free cash flow here, which we calculate in the DCF and the cash flow statement itself. So all this additional information, if you can get it, you want to disclose that in your financial model. Hold on a second. Here we go. Geographies. You want to make sure that you disclose this as well. You put that at the bottom of your income statement. Put down every piece of information they give you, even if you don't know how to use it yet, because you might in a future quarter that you're modeling. And a best practice is to do the following. When the company reports earnings, of course, you update your financial statements and you listen to the quarterly earnings call. Anybody can do it because of Regulation FD, fair disclosure, but I digress. Whenever a company reports earnings, if they have an earnings call, listen to it. And usually the way it works is this. For the first half hour, investor relations and the CEO and CFO will talk about how great of a quarter they had. Then what will happen is the most important part of the call, which is for 15 minutes to 30 minutes, Q&A with Wall Street analysts. And you want to listen to those questions closely because that is one of the only times that the management team can openly discuss their forward-looking financial statements. And they can also discuss things like, why was operating margins down? Or what is your long-term target for gross margins? And whatever they say, you want to document that in your model. And you want to say, put the date in as well and who said it. So here's how you do it. You create new note. On Windows, you can hit, just right-click new note. And what you do is you type this, quarterly conference call, then you put the date here. And then you put the executive who said it. And then you type here, they said 30%, blah, 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 whatever it is. Let me just Control-Z to undo that. And you want to add tons of comments because that will really help you when you're forecasting the future in your financial model. Let's go back now and let's take a look at this prompt to see if there was a change in GAAP versus non-GAAP accounting. It's not applicable to Apple, but I'm going to paste it anyway, just out of curiosity to see what they say. And a lot more companies are only going to be releasing GAAP earnings and not non-GAAP. I think Facebook was one of the first big notable companies to do that, but we'll see what ChatGPT comes up with here. All right, let's see what it came up with. It basically printed a bunch of stuff that could have been summarized in, we only use GAAP. But right here, we can see that 95%, according to ChatGPT, 95% of companies in the S&P 500 provide GAAP, meaning accounting, what accountants love to look at, versus non-GAAP. They provide GAAP and non-GAAP financial statements. Non-GAAP is what finance people look at, also called pro forma. But again, all of this could have been summarized with Apple doesn't look at non-GAAP anymore. And here is the commentary on GAAP versus non-GAAP for Apple. So what I'll do is I will copy this and paste this, and we are now done with this part of our research process. Let's talk about revenue recognition changes. We're going to ask the AI product we're going to use here. Over the past few years, has there been any changes when it comes to revenue recognition? If so, explain why. So let's take a look. And we might not get very much information on this from using AI products. So what I'm going to do is I'm going to go directly to the most important document to look at, which is the 10K for revenue recognition. Before we do that, though, let's copy this and let's use ChatGPT. Let's take a look at the results here. It's not really helpful. It's going back to the nano days. Remember the Steve Jobs conference when he said, There's one more thing he introduced in Nano. Oh, the upgrade program could cause changes to RevRec. Makes sense. When I got my iPhone, they basically said I'm part of the upgrade program where I can get a new one next year. That might impact deferred revenue, but I don't see really anything detailed here. So what I'm going to do is I'm going to copy this and paste this, and I'm going to show you where to get the best RevRec or revenue recognition source on any company. You always go right to the source. So let's go to Investor Relations for Apple. And you can always go to sec.gov as well. By law, they have to file all this stuff at sec.gov, but quite often they put it on their website. So the 10K, meaning the annual report. And all you have to do is do a search for revenue recognition right here. And it will tell you exactly how the company recognizes revenue. And you can even take this and put this obviously in your research report as an excerpt from the 10K. It's important to analyze material charges and write-offs. Now, quite often what companies do is they can do a material charge in a given quarter, maybe with respect to a lawsuit where they had to pay somebody suing them a material amount of money. Now, this isn't something that you're going to model every quarter. It's usually one time in nature. But it's important to take a look at, especially because you want to scrutinize and analyze what the cash balance is and will be for a company. And so a lot of companies will take big charges or kitchen sink a quarter when many other companies are doing the same thing. An example of this is the tragic events that occurred on September 11, 2001. What happened was when everybody reported earnings, people knew obviously they weren't going to have good earnings. And so some CFOs took that as an opportunity to take a lot of charges, to kitchen sink it, so to speak. So let's take a look if Apple had a material charge or a write-off. And I remember, I think it was back in 04 or 05, a lot of companies took charges when it came to a change in the way they accounted for stock options. So let me copy this and we'll go to ChatGPT. I don't think we'll come up with too much, but we'll see. All right. 3-word answer, I don't know. Probably couldn't find anything. So let's try again in Bard. I'm not that confident with using Bard. I found so many mistakes here. Although I do love the fact that you can get a lot of documents that you can export directly to Google Sheets. So here are some charges here. $3.5 billion charge for inventory write-downs. $4.3 billion charge for iPhone sales. So there are some material sales or material charges. It's not going to move the needle too much relative to the revenue that Apple generates. So what I'll do is I will copy this and put this in our document. And as always, you're going to have to double check all this stuff. So I'll paste here, paste special, and we are now done looking at material charges and write-offs. It's important to look at lawsuits that are material with respect to accounting issues. Sometimes what will happen is a company might mislead investors, which can result in a shareholder lawsuit. So you want to make sure that you document this and you thoroughly understand this as well. Now, we're going to ask ChatGPT if there have been any material lawsuits with respect to the accounting practices of Apple. And then what I'm going to do is I'm going to show you where to go directly to the source to find out more details on lawsuits. There was just a ton of information that was generated here, and then it stopped generating. There was an error. So what I'm going to do is I'm actually going to copy this and still paste it, and then we'll look at it together here. I'll go paste and try it again. Didn't let me copy it. How strange. So I'm going to highlight it here and copy it. It took a long time to get this result. Copy. And then I'll go here and then I'll paste special, and then we'll look at it very quickly together. All right, here we go. So when it comes to lawsuits, it listed a bunch of lawsuits that aren't related to accounting issues, but it's important to take a quick look at this. And you probably only want to focus on lawsuits that are well over $1 billion because that would move the needle with Apple. Otherwise, it's not really worth our time taking a look at. But here we have a lot of details when it comes to billion-dollar lawsuits here with defective batteries. Over here, we've got $1 billion with respect to Apple Pay. You want to look at that. And then at some point, what's going to happen I think what's going to happen is big tech companies are going to be broken up by the Department of Justice, and the EU might put pressure on big tech to do this as well. You have too many large tech companies that are dominating, which is not good for competition. If you think about it, if Android didn't exist, then we would pay for every operating system upgrade we would have with the iPhone, for example. And so there's kind of a duopoly, it's an oligopoly, I should say, in the sector, with Google and Apple dominating. So I think eventually these companies will be broken up. It's good for the consumer. Competition is good for us from a pricing and innovation perspective. It's important to look at lawsuits that are material with respect to accounting issues. Sometimes what will happen is a company might mislead investors, which can result in a shareholder lawsuit. So you want to make sure that you document this and you thoroughly understand this as well. Now, we're going to ask ChatGPT if there have been any material lawsuits with respect to the accounting practices of Apple. And then what I'm going to do is I'm going to show you where to go directly to the source to find out more details on lawsuits. There was just a ton of information that was generated here, and then it stopped generating. There was an error. So what I'm going to do is I'm actually going to copy this and still paste it, and then we'll look at it together here. I'll go paste and try it again. Didn't let me copy it. How strange. So I'm going to highlight it here and copy it. It took a long time to get this result. Copy. And then I'll go here and then I'll paste special, and then we'll look at it very quickly together. All right, here we go. So when it comes to lawsuits, it listed a bunch of lawsuits that aren't related to accounting issues, but it's important to take a quick look at this. And you probably only want to focus on lawsuits that are well over $1 billion, because that would move the needle with Apple. Otherwise, it's not really worth our time taking a look at. But here we have a lot of details when it comes to billion-dollar lawsuits here with defective batteries. Over here, we've got $1 billion with respect to Apple Pay. You want to look at that. And then at some point, what's going to happen I think what's going to happen is big tech companies are going to be broken up by the Department of Justice, and the EU might put pressure on big tech to do this as well. You have too many large tech companies that are dominating, which is not good for competition. If you think about it, if Android didn't exist, then we would pay for every operating system upgrade we would have with the iPhone, for example. And so there's kind of a duopoly, it's an oligopoly, I should say, in the sector, with Google and Apple dominating. So I think eventually these companies will be broken up. It's good for the consumer. Competition is good for us from a pricing and innovation perspective. Although we've done a lot of research together on accounting issues, there might be some things that we've overlooked. So what I did was I wrote here, what are other potential accounting concerns for the company and why? So I'll copy this, and some of the information that we get back might be redundant. Let me go to a new chat here. And if we get redundancy, then obviously we only copy and paste what we need to copy and paste into our document. Well, I'm glad we did this, because there are a certain number of issues that we haven't accounted for yet in our research report here. RevRec, we sort of covered supply chain disruption, cost Apple $6 billion in sales. So we definitely want to look into that. Inventory valuation, we saw that before with respect to inventory write down for iPhones, which I think was $4 billion. See, there's no numbers here for environmental, social, and governance. So what we can do is we can copy this and paste this into our document, and we're done at looking at other potential accounting concerns. Now, as a next step, if you want, you can go through everything we just looked at and incorporate that into your financial model. Or you can wait until we build our financial model together in the next section, to copy and paste items that we found here into our financial model as notes.